When you look at the relative earnings growth, it's going to decelerate for that Mag 7. And it's going to be overtaken by the forgotten 493.
It's not so much about the earnings results. It's about the reaction of the stock to the earnings results.
When we listen to earnings calls, we're starting to see a normalization in consumer spending trends.
What you are hearing is consumer demand that's held up better than a lot of people expected.
We get 30% of earnings this week. We got to go. We got to get the engine humming here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. One name to watch this morning, and that's Tesla. The stock is higher by more than 10%. And Elon Musk saying all the right things on a call yesterday. Much less about robo-taxis. Bramo, much more on less expensive models.
I view this as Operation Kick the Can to August, because essentially that's what we heard. We're not going to get any details about the way that they can produce $25,000 Teslas on their current infrastructure. Wait till August. What about robotaxis? Wait for August. And you know what? That was enough for shareholders.
We're going to wait for August. So let's look at this move this morning. I don't think you can look at this move without looking at it relative to the year-to-date loss. Before this, we were down by 4%, so now we're up by 10. Deutsche Bank's Jim Reed, I think, doing a fantastic job of framing just how far this name has fallen. AMH, listen to this. At its peak 2.5 years ago, Tesla was worth the same amount as the next 12 largest global auto companies. That's how much things have gone wrong in the last couple of years.
And recently, the big issue, of course, is demand. I love what Liam Denning says this morning of Bloomberg Opinion. He says Tesla has two very different first quarter results announcements, depending on whether you're more into the numbers or the words. The numbers, they were bad. If you look at some of the rate of which new cars are leaving deliveries, that is very not promising for Elon Musk down the road. But the words are dreamy. And it's this whole idea, to Lisa's point, August. We're going to get maybe a cheaper cars or new cars or cheaper Model S and potentially a robo-taxi.
It goes through the reaction from the South Side. Morgan Stanley, something for everyone. I think we can all agree with that. Jeffries, appeasing the market. That's the point I want to get on. How much of this was just about appeasing the market after all the concerns it's had over the last few weeks?
I mean, at a certain point, does it matter for Elon Musk what he actually promises if he could just get a longer leash to go and fulfill those promises? Ultimately, there's been a big question, and we've been talking about it a lot here. Is this a car company? Is this a tech company? To that valuation story you were talking about that Jim Reed pointed out, he gave enough hope, the dreamy talk that Annmarie was talking about, maybe to put this back into something more than just a car company.
It felt like Dan Ives of Wedbush wrote the script on the call for Elon Musk yesterday. I think this is exactly what he wanted to see. An adult in the room, I think that's something like what Dan would say. Let's talk about what's happening down in Washington, D.C. How many adults do we have in a room? $95 billion aid package passed, and apparently the clock has started ticking on TikTok. Is that true?
Absolutely. 270 days they have for it to face a ban or divest. This comes the day before the inauguration of the next president, but the president does have authority to then kick this can down the road for another 90 days, regardless of what happens with TikTok. Does it get divested? Is it banned? The issue will have to be dealt with the next administration. So it's either going to be Trump 2.0 or Biden 2.0.
Everybody can get on board with something that's not going to happen until after everyone kind of makes these decisions. I thought it was interesting to, within that $95 billion aid package, there was also a provision about unlocking seized Russian assets and giving that funding to Ukraine, raising the question, do they have to pass additional funding for Ukraine, or can they use that money in a different kind of way in coordination with Europe? And it's something we're going to be hearing more about.
Yeah, this accelerates the conversation about the confiscated assets that are in Europe, particularly in France, in Belgium, as we go towards that leaders' meeting. The G7 meeting just around the corner in the middle of June over in Italy. I want to talk about this poll that came out this morning. Bloomberg alongside Morning Consult. I think we put it this way this morning. The Biden bump, AMH looks over, and it looks over for now.
This is the latest iteration of our poll. The previous month, this came after the State of the Union. Biden did receive a bit of a bump. Now he's pretty much back to where he was before the State of the Union. And the issue continues to be the economy. If you look at voters and you ask them who's responsible for your concerns like inflation, they say Biden is responsible or very responsible. And then you ask them, how do you feel about inflation in the future? How do you feel about interest rates coming down? It's a grim picture. And this is what is really weighing on his poll numbers.
Mario Parker joining us from Washington, D.C. in about 25 minutes' time. Look out for that. Equity futures right now on the S&P fading just a touch. We're positive by 0.1%, coming off the back of the biggest one-day pop on the S&P 500 going back to mid-February. It's been a couple of months. In the bond market, yields higher again by 3 basis points, 463.14. German business confidence a little bit better than expected, but a euro still negative by 0.1%, 106.87 on euro dollar. Coming up this hour, Katrina Dudley of Franklin Templeton as stocks bounce back, Pierre Ferragu of New Street as Tesla speeds up plans for a cheaper model, and Brian Weeser of Madison & Wall with Meta earnings on deck. We begin with our top story, tech heavyweights lifting the S&P 500 to its best back-to-back rally in 2 months. Katrina Dudley of Franklin Templeton saying this: strong economic growth is good for companies as we have a strong macro backdrop, but valuations are looking fair to us rather than expensive. Katrina joins us around the table. Katrina, good morning to you.
Good morning.
Let's get into the earnings. So we've had Tesla, we've had GM, we've got more coming up a little bit later. What's the message you're taking away from what we've heard from corporate America so far?
At the moment, we've had close to 20% of the S&P report. So we have a reasonable sample, but there's a lot coming over the next 10 days. Earnings matter. And that's really clear. The fact is if you take a look at what we've seen over the first quarter, basically the returns to the S&P are in line with earnings growth. So you've had valuations flattish. And that's where we come back to that comment. We think that valuations are fair. Therefore, for the S&P to work as we go through the rest of the year, we need to continue to deliver on earnings growth. So we've really got to start digging into the details and understanding what is driving earnings.
Let's start with sectors. Let's go within the S&P 500. Where do you believe there is greater scope for earnings growth this year?
I think the easy one is the technology sector, and we can sit here and talk about AI, but I don't think that that's news to anyone there. We're looking at financials as another area where you've seen some good earnings momentum, and we expect that to continue. Some of the areas where we're starting to see weakness, though, are the healthcare sector, which has typically been such a defensive area. I think the expectations there are for earnings to have some degree of pressure. And then finally, energy and materials. But when I look at earnings in energy and materials, I think about it in terms of so much of their revenue is outside of their control. They've got the costs under their ability to influence. Therefore, I think that using that as a barometer of earnings isn't a really good a guide to the future of the market.
Just to dig a little further, you were saying that you expect earnings growth to come in big tech. More than the valuations already priced in so far?
I think that the valuations that are priced in so far are actually pricing in the fact that this is the place that you want to be in terms of technology. When we look at tech, however, we take a much broader definition of where tech impacts. And so we're not just looking at those magnificent 7, where the valuations probably are on the fairish to upper end of where we think is reasonable. But we're looking at where the second derivative impacts of AI are going to come into effect. I look at our business and I look at how we're deploying it. And we're deploying it not just in terms of our commentary writing and helping that. I'm actually deploying it as I work with my team and looking at agendas for how I have their review conversations. I look at for agenda planning for meetings. So me as a person, it's starting to use AI in a very blunt manner to make myself more efficient and more effective.
There's a question of hope versus dollars and cents. And we were talking about that in terms of Elon Musk and Tesla. And it really comes down to, as an investor, do you invest in the hope of capital expenditures, of promises, of shooting a high, or do you really focus on the dollars and cents? How much money are they bringing in, and what does their cash pile look like?
I think the first thing is you invest in credibility. And that is what we have to do. That's why we go in and we meet the CEO and we look at them in the eye and we say to them, what do you think you're going to deliver? And what can I metric you on? Because that's something a CEO has the right to tell us, is that these are the things that I'm focused on and I'm going to deliver. The good news is if you have longevity as a CEO, and longevity here is a probably relative term, I can kind of use your own history as a guide. Did you deliver last time on the promises you made? And that's usually a good indicator that you'll do them. So I would say it's not necessarily hope. It's about having that conversation with the people that matter, then understanding what those metrics are. And then we go out and we try and form that mosaic of how do we assess those metrics and whether they can deliver.
Have earnings fully trumped the bond market at this point, at a time when we are seeing sort of whipsaw moves in yields appear to still influence stocks, even if people want to say that they don't.
Look, as we go into an environment where we have inflation easing, we will see a decoupling of the bond market and the equity market. That's something that we've had in the past, of those markets both working in tandem. We are expecting rate cuts coming into the second part of the year, but we are also hawkishly watching that inflation number. As I look at what the expectations, though, and that's really what that drives that bond market, it was 6 cuts at the beginning of the year. That's only 4 months ago. It wasn't that long ago we were expecting 6 cuts. Now it's down to 4, potentially 2 to 3 is what our CIOs are telling us.
When you look at earnings, you talk about energy and materials, and you expect them to drop 8% and 25% respectively. Mm-hmm. But if we continue to see this commodities rally, would now then be a good time to buy into these sectors?
I think the 8% drop is in terms of healthcare earnings. And so that was what we were talking before. And there's some definite pressures there that we're seeing in the healthcare system. As we look at the energy and materials sector, I think really that sector is a good barometer for what we're expecting in the macro environment, number one. Number two, it is also a kind of second derivative play on emerging markets and what you're expecting to see in those environments. As we look at some of these emerging markets, I think that there's a bit of a bifurcation here, because there's some of these emerging markets that have got some really good, strong trends, but there's also a lot of geopolitical tensions. And when we see a rise in geopolitical tensions, the emerging markets just cannot escape that.
Can we finish on Japan just briefly? So we came into April worried about 152. We sliced through 152 like a hot knife through butter. 153, 154. We're looking at 155 this morning. We came close, 154.97. What is it going to take for Japanese officials to step in, and can they change this trend?
I think what the Japanese officials are looking at the moment is things that are actually really within their control and make a lot of difference to the equity markets. And this is a change. We have not had a regulator in Japan that is actually looking at capital allocation and how companies are allocating capital. So I understand the narrative, and I do know that everyone is focused on the BOJ and what's happening there. But we're actually focusing on the ground, and we're looking at the message that's been given to companies. And I think that that's just got such a much longer tail to it, and I don't need to really make a call on what is a binary decision here.
You're not alone, let me tell you that. If you ask people their 2 favourite sectors right now, they might talk about what's happening with tech. You ask them about their favourite regions, they will name 2. The United States and Japan comes up repeatedly. Katrina, this was great. It's good to see you.
Good to see
Katrina
you.
Dudley there at Franklin Templeton, very close to 155 on daily yen. Right now, 154.92. At the moment, Bramo, the high of the session, 154.97.
This is what's interesting to me. When we talk to people, everyone's going to Japan. Every single person who comes in who's doing international travel has been to Japan, and they say there's actually hope, there are dreams, etc. At what point, though, if you get a depreciating yen, does it become a headwind for some of these investors? And it's something that we hear more as the days go on.
Let's get you up to speed on news elsewhere. Let's get to the Bloomberg brief. We can kick things off with shares of Tesla. Surging in the pre-market, the EV maker accelerating the launch of less expensive cars in a bid to revive sagging demand. The news overshadowed a big shortfall in company first quarter earnings, sales and margins. The CEO, Elon Musk, says he wants to start production of the cheaper models this year. Your second story from JP Morgan Chase CEO Jamie Dimon says he's on the cautious side of a soft landing, but he's optimistic on the state of the consumer.
Even when we go to recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
Dimon spoke at the Economic Club of New York just yesterday. And finally, quite a story, the FTC voting to adopt a near total ban on non-compete provisions that prohibit workers from switching jobs within an industry. The Chamber of Commerce vowed to immediately challenge it in court. The legal showdown comes 3 years after President Biden signed an executive order encouraging the FTC to limit non-compete agreements, which affect roughly 1 in 5 Americans. The rule does not apply to existing non-competes for executives who earn more than $151,000 a year in a, quote, policy-making position. So any execs out there this morning who were getting excited about breaking their non-compete, maybe don't get too excited. I remember the late, great Alan Kruger gave me an education on this many years ago, and he talked about how important this was for fast food workers. I was sitting there, I was like, Alan, what are you talking about? And he broke it down for me. I could not believe that if you work at a fast food chain, you have to sign some of these. And in some cases, you can't even go and work for the same chain at a different franchise. They prevent you from doing that as well. So this is not about the bankers of this world. It's not about the execs. It's about what happens in the lower paid jobs in America.
Which is the reason why this is coming now. I find this really interesting. I personally saw this, especially in tandem with a rule that would go into effect that would allow certain types of expansion in overtime payments. It raises a question, what are the knock-on effects, though, at a time where the FTC has taken a much more aggressive approach to monitoring business? The intent has a lot of resonance in the American society. There is a question about the precedent being set that I think a lot of people are going to be compelled to discuss.
Lena Khan also spoke about when they opened this up for comments. A lot of those comments came from individuals in the healthcare space. But you have to think, state by state, some states already outban non-competes, so you can't even have it. Knock-on effect, I think, is going to be a ton of legal action. We've already seen it from Chamber of Commerce, and also a political win for Biden. 2.5 years ago, an executive order telling the FTC, do something about non-competes. 6 months before the election, here we go.
Easy now. Political win at the moment. This is going to get caught up in appeal after appeal. Up next on the program, Tesla doubling down on cheaper cars.
We know that when Elon says something, it often takes 4 years after the initial comment. So I can't rely on what he says as a time frame, because those are usually his goals, not necessarily a reality.
Some people have their doubts. We'll talk about those doubts up next on the program. Live from New York City this morning. Good morning.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Equity futures on the S&P 500 positive here by 0.1%, just a little bit of a lift here. Yields higher as well by 3 basis points. A 10-year 463.35. Under surveillance this morning, Tesla doubling down on cheaper cars.
I don't see how they're going to pull forward production of this vehicle to be ready in a year after they just laid off 15,000 people and a lot of factories and a lot of high quality individuals just lost their jobs. So I'm kind of curious to, we can say things, but we know that when Elon says something, it often takes 4 years after the initial comment. So I can't rely on what he says as a time frame, because those are usually his goals, not necessarily a reality.
Here's the latest this morning. Shares of Tesla jumping on its plans to speed up the launch of cheaper models. The EV maker also posting better than expected results despite a miss on earnings, sales and margins. Pierre Ferro of New Street Research writing this. The world didn't play out as expected. Demand for expensive EVs didn't grow as much as hoped. In 6 months, Tesla adjusted strategy in order to make the most of assets on the ground before investing in the next round of production capacity. Pierre has a buy rating on the stock, a 280 price target. Pierre joins us right now for more. Pierre, you have an original take on this. You think something much bigger is going on here, not just a CEO trying to please investors on an earnings call. Can you walk us through how big a change you're expecting from this company?
Yeah, I think, John, thanks for your comment. And to be honest, my perspective is not that, original. What's original is how the news came to us and how, things got spun into a misunderstanding. So you remember that article from Reuters a couple of weeks ago mentioning that Tesla was dropping the Model 2. Of course, there is no smoke without a fire. There was something happening that Reuters journalists saw happening at Tesla. And we tried to put our head around what Tesla could be doing. And people thought maybe the Model 2 is going to be cancelled or postponed, but it didn't really make sense. The reality was actually the exact opposite from the way Reuters presented the situation, which was the Model 2 initiatives suddenly come across as being something that needed to be accelerated and not postponed or cancelled. And that's what Elon Musk told employees in February. He said, guys, we were planning to sell 3 million Model 3 and Model Ys a year. At these price points, it's not going to happen. The demand is not large enough at these price points for that to happen. So we need something like a Model 2 that comes in earlier, number one, to continue to grow. And number two, we've planned for capacity for Model 3 and Model Y that is way too much, because we're never going to sell 3 million units at a price point that makes sense based on the cost base today. So let's take some of the projects, like the plans we have, part of the Model 2 next generation platform, and let's actually integrate these innovations into the Model 3, Model Y platform in order to be able to hit the market ASAP with less expensive cars. And so what I see coming through in 2025, and I think Ross has a point, let's see how fast it comes. Elon Musk tends to guide for things to happen very, very fast, and they take a bit longer to realize. But it's going to happen soon, because it's not going to be about like building a new production chain and like tooling a new manufacturing line. Is going to be adapting the existing manufacturing lines in order to take some of the cost reduction initiatives of Model 2 and integrate them on the Model 3, Model Y platform. Yeah. That's what I'm expecting to see coming. And the Model 2 will come later, once existing production capacity will have been fully utilized.
Pierre, I am wondering whether it bothers you at all that we got no details, that the line was basically wait for August and we'll tell you more about how exactly we're going to do this.
No, I think it makes a lot of sense, do you get details about the next iPhone before Tim is presenting it at an Apple event? You have to remember that Tesla is not running an IR department. They're running like a car company. So they have to be very careful to talk about what they're doing and reassure investors the way they can with public information. But they don't want to disrupt their business with too much information being given to shareholders. Let me give you like a simple example. If they were saying, we're aiming in a year from now to have like a Model 3 that is going to be 25% cheaper than what it is today, that might have like a disastrous near-term impact on sales for Tesla. So to me, it makes sense to be very vague and high level on guidance. And then on the robotaxi per se, I think Elon is giving actually a lot of details, but that's details about his dream, about like something that is still like very much of a moonshot and like a vision. How these AI models are evolving. Sam Altman describes that very well. You develop a new model and you're facing a veil of ignorance. You don't know what the model is going to do next. You just see that the technology is improving and is building up capabilities very, very rapidly, but you don't know what's going to happen next. So Tesla is working on these new models. They have additional compute processing power. They are developing in-house models that are like, according to Elon, like very impressive. Putting that into a putting a robotaxi on the road, to me, is still a process that is going to take another, 3 to 10 years, and 3 years. To be honest, I don't really. I would be skeptical. So, in August, they're going to talk about the platform, how the robotaxi car, what the robotaxi car is going to look like, what the embedded technology is going to look like, how like the technologies, the software is going to differ from the mainstream car. And then once they have these platforms, these prototypes, they have to produce it, they need to deploy test fleets and things like that. And it's still going to be a multi-year project, and still to me qualifies as a moonshot.
The stock agrees with you this morning. Pierre, it's great to get your view on things right now. Pierre Ferro there of New Street Research. That name is up in double digits this morning, 10 to 11% higher. This from Pierre Ferro of New Street. After those earnings, this could be a case study for the Harvard Business Review.
Basically, how you deal with trying to expedite a cheaper model without having to build a whole new infrastructure. Whether he actually can do it, I mean, it's sort of interesting, the sort of benefit of the doubt. Well, of course, you're not going to release any details. It's a car company, even though it wants to also be a tech company, and you're really going on faith.
But when it comes to robotaxi, I love what Musk said on the call. If someone does not believe Tesla will solve autonomy, they should not be investing in the company. He is throwing really all his eggs in this basket. Then maybe on the side, to assuage some investors' concern, don't worry, we're going to have a cheaper price point when it comes to the EV.
Pierre mentioned investor relations. Do they have that department at Tesla?
I believe that person resigned after the call yesterday.
So, there you go. Equity futures right now, positive. by 1/10%. And coming up next, we'll catch up with Bloomberg's Mario Parker on the latest Bloomberg Morning Consult poll, focusing on key swing states, the Biden bump evaporating. That conversation up next. Coming off the back of 2 days of gains on the S&P 500, equity futures slightly elevated by 0.1% on the Nasdaq 100. Encouraged by some of the moves elsewhere, the Nasdaq is up by 0.6%. We'll talk about Tesla in just a moment. Off the back of the biggest one-day move on the S&P 500 in about 2 months. In the bond market, bit of a bitch yesterday. Decent auction at the front end of the curve. Softer economic data supporting that decent auction, some might say. 463 on a 10-year, 2-year 493.73. Who would have thought? PMIs in America. S&P PMIs would get everyone encouraged that the economy was slowing down.
That was exactly my point. Is that how low the bar is for any potential miss or sign of weakness, that'll give a huge boost to bonds and stock markets pretty much across the board? You got weak PMI data, but more importantly, and this is what people looked at, the internals of the S&P Global PMI data showing the weakest hiring levels, particularly in services going back to the height of the pandemic in 2020. This was enough to be the first punch. And then the second punch was the auction. It came out, record amounts. Oh my God, are people going to come out? They did, and it was fine, and you saw that continue.
Yeah, that was $69 billion of 2-year notes, and I think later today, Lisa's got the numbers. She knows them. $70 billion of 5-year notes. There we go. All right, that's the bond market. Let's turn to foreign exchange. I'll talk about the euro briefly, and we'll throw in some dollar yen as well. The euro at the moment is negative about 0.1%, staging just a little bit of a recovery. Business confidence in Germany doing okay. Not stellar, but doing okay. 106.91. The fireworks could come from dollar yen at any point, getting closer and closer to 155, 154.92. Just remember where we were coming into April, looking at 152, gone, 153, gone, 154 through that level, staring down the barrel of 155. And I would say this, officials in the finance ministry have got quieter and not louder over the last few weeks.
Partly because people have rejected their verbal intervention. It's lost credibility. And at a certain point, is this going to come down to what they decide to do and when they decide to intervene? Or is this going to come down ultimately to what data comes out? And maybe we'll get another S&P Global softer PMI print, and that'll be enough to bolster some of the yen valuation.
That's what they need. A few more of those. Perhaps. That's the price action in foreign exchange. Let's get to under surveillance this morning. Our top stories. Tesla ramping up plans to launch cheaper models. The EV maker hoping to start production as soon as this year. The announcement overshadowing a shortfall in Tesla's first quarter earnings, sales and margins. That stock is up by almost 12%. Elsewhere, Kering shares falling on slumping sales of its biggest brand, Gucci. The stock near its lowest level since 2018. The luxury maker also warning profit will plunge in the first half of the year as demand eases in China. Kering is lagging behind some of the other big players, including LVMH. We're down here by 8% on the morning.
So there are two questions. How much is this a story, and I'm sure you guys can do this much better than I, about designers or sort of their customer base? It's very idiosyncratic. And how much is this truly a bifurcation between the ultra-rich, which are doing great, and the lower class, which are not doing well? And if you try to hit the middle, not so good. And that's kind of what they kept on kind of pointing to, is that we're the accessible fashion, and accessible fashion isn't in vogue. You might have a different take.
So if you ask the CEO of Kering, they'll go with the former, or rather the latter. They will say this is about the polarization of the luxury goods market, that ultimately it's either hyper luxury or it's low end and it's super accessible. They're somewhere in between. They can't get it done. Of course they would say that. If you ask other people about this, they'll point to the designs and how much the designs have changed over the last few years. And ultimately they built out this consumer base with a very particular design, then they've changed it, and that consumer base is not there anymore.
That's what I think, because you had Alessandro Michele at the helm as the creative director. This extrovert, he did some wild things. He brought like the New York Yankees logo to their loafers, and then they realized, well, this is actually a younger audience. How do we broaden this base again? So then they brought in Sabato Di Sarno, and he's a little bit more classic. You see
from Valentino.
From Valentino, which is very quiet luxury. And then what you see them putting out are things like the Jackie O handbag. This was the style in the 50s and the 60s with the bamboo handle. But they just did all this work to bring in a younger generation. So it's going to take some years for them to recalibrate to this new creative director and his design vision.
We need to get the CEO on the show so we can have this argument.
Yeah. Do you like loud fashion?
No.
What do you think of... I mean, isn't that essentially what this is? I wasn't asking you. I was asking the CEO.
I'm not big on logos and brands.
Well, but that wasn't that Gucci's whole thing?
Not a big fan of platforms.
But that's the whole thing. If they want that crowd, if they want that crowd, they got that crowd, and now they're ditching that crowd, and they're wondering what happened.
Francois Pinault in Vogue recently, I didn't want a rupture, I wanted an evolution. They wanted to bring more people back in.
Like John.
But it's very different to go from Alessandro Michele to Di Sarno. It's apples, oranges.
The Kering is down by close to 8%. Who would have thought that would be the most excitement we'd get around this table this morning? Elsewhere, President Biden pledging to sign a $95 billion aid package for Israel, Ukraine and Taiwan. The deal passing in the Senate last night. The Defense Department hoping to resume arms shipments to Kyiv in the coming days. Biden's signature will also start a countdown for ByteDance to divest from TikTok or face a ban. We can spend lots of time talking about TikTok through this morning. I just want to say this on the foreign aid package. Only a month or so ago, this was almost unthinkable that this would pass. The doubts around this were absolutely massive. A little bit later, we'll catch up with Henrietta Trays of Vader Partners, and I think it's important to question the amount of influence, or lack thereof, the former president still has over the Republican Party, particularly on this issue.
Well, I would go down to the vote cap. You're sure the Senate passed this as one bill, but the vote count in the House was 4 separate bills. And you look at where it was on Israel, you look at where it was Taiwan, a lot of bipartisan support. There was still bipartisan support for Ukraine, but you saw a lot of protest votes when it comes to Republicans, which makes me think, is this the final aid package then this kind of Congress can get through? And what does this spell if we do get a Trump 2.0?
Some people might argue that Trump did give his blessing in the form of not asking for Mike Johnson's ouster, that maybe that was enough to give them the belief that Republicans wouldn't get pilloried if they signed off on this. He wasn't aggressively arguing against it. So maybe people were saying he's kind of not really against it anymore. But you heard this kind of, pretzel twisting down in Washington, D.C.
He was against the TikTok effort. And apparently it's ready to blame President Biden for getting rid of your TikTok if that happens.
Yeah, well, he wants it to happen before he can talk about people getting rid of it.
It depends what year you're talking about, if Trump was against or for the TikTok ban, because he also tried to ban it when he was in the presidency and had the White House. But now he's like, if it gets banned, he wants to blame it all on Biden.
Yeah, I remember the combined effort. Was it Oracle and Walmart back in the day? It's so weird.
Well,
feels like ages ago.
There was a great article, I think it was in the Wall Street Journal, about Jeffrey Yass, who is the billionaire who has been the biggest Republican donor, and frankly, the biggest donor during this political cycle, who has almost all of his money tied up in TikTok. It kind of gives some color to this whole issue.
If you want a decent feeling for how quickly time flies, yesterday was the 4-year anniversary of the Inject Bleach speech, that address.
That
Did you
tweet
see
was
that?
gold, yeah.
4-year anniversary?
Yeah.
4 years, where's that gone?
It's crazy.
I remember sitting there in the living room watching that address in the press conference. It was some weird times, let's put it that way. Equity futures on the S&P right now up 0.1%. Equities are doing OK, coming off the back of 2 days of gains. We need to talk about some of the recent polling. President Biden losing ground in key battleground states. According to the latest Bloomberg Morning Consult poll, Biden now leading in just 1 of 7 states in his matchup with former President Donald Trump. The results showing a fade from the post-State of the Union bump for the president. Bloomberg's Mario Parker joins us now for more. Mario, let's talk about that bump, where it was coming from, and ultimately why it's fading.
Sure. I mean, the main thing, Jonathan, is the fact that Americans remain pessimistic about the economy, namely inflation. One of the problems, you all just talked about some of the nostalgia from 4 years ago. One of the frustrations for President Biden and Democrats is the fact that Americans remember the prices, the lower prices that were around during the pandemic, but not some of the other stuff that happened with the Trump administration during that time as well. And so right now it's been an albatross on his reelection prospects.
Mario, though, when you look at some of the other polling data we have, Biden does poll well with suburban women, and the issue of abortion continues to come up. Is this where we can see the president really lean into this November?
Well, that's the bet that the president is making, right? You saw him earlier this week go down to Tampa, Florida, right? Which is essentially a move that suggests he's going on offense, even as polling shows him trailing in some of the key battleground states that he needs to defend. But he went down there carrying a message about abortion. He's hoping, and the Democrats are hoping, so far, anytime abortion has been on a referendum, it's been abortion rights have gone in favor of Democrats, right? So they're hoping that, hey, let's swing for the fences and put all our chips in the middle of the table. Come November, we'll be able to galvanize turnout among independent suburban women and also the Democratic base. The problem is it's just not showing quite yet with the potency of the economy.
And then, Mario, the third rail of politics is entitlements. Any politician that comes out and talks about potentially reforming Social Security or Medicare, you pretty much no longer may have a job. But on our poll shows that there is one provision potentially that could work to shore up Social Security that voters actually like.
Yes, and it's if that's the taxing the rich, essentially, billionaires tax. And to your point, Annmarie, it is the third rail. You saw in the Republican primary just how potent an issue it was, because you had former President Donald Trump kind of waffling around the issue, he and Nikki Haley, on that. Just because, given, if you recall, older voters are a reliable bloc come November. No one wants to alienate that block at all. But yes, the overwhelming, about 77%, I think, of the respondents to the poll were in favor of taxing billionaires in order to make sure that the program remains solvent.
Mario, I love this part of the political cycle where we get to find out why Michigan, Georgia, Arizona, Nevada, North Carolina, Pennsylvania, Wisconsin have that much greater clout over all political decision-making than any other states in this country. We saw Michigan, President Biden gaining by 2 percentage points, but losing in all of the others. What types of proposals, provisions, lip service can we expect from President Biden to try to get the Georgia, Arizona, Nevada, North Carolina, Pennsylvania, and Wisconsins on board?
Ooh, that's quite the list, right? You got about 7 months or so, if you're the president, to essentially blitz those states as much as possible, to get there as much as possible, to generate earned media with those trips. And one such trip is he's going to give the commencement address at Morehouse College, a historically black college and university, a male university in Georgia. What we know right now is that the black vote, the young male vote, Georgia, all those things have been blinking red lights for the president. So you'll see the campaign find creative ways to visit some of those states, to deliver messages tailor-made to some of those states as well in the coming months.
Mario, do you think Biden can win without winning the blue wall?
No. And I don't think the Biden campaign, just speaking with them, they feel as though they have to absolutely keep that blue wall, the blue wall being Michigan, Wisconsin, Pennsylvania. That's absolutely vital. You have to at least win 2 of the 3. For sure. Ideally, you have to win all 3 in terms of getting back to the White House if you're President Biden.
Hey, Mario, appreciate your time this morning. Thank you, sir. Mario Parker there of Bloomberg on the latest Bloomberg Morning Consult poll. Lots of interesting details in here. This is the one that stood out for me. More than 3/4 of poll respondents said the president is responsible for the current performance of the US economy. Nearly half said he was very responsible. If things improve, do they thank him? Because at the moment, the perception of the economy, very, very different to what we talk about around this table. We talk about solid economic growth, jobs are plentiful, the disinflation at the start of the year, challenge to that for sure. But ultimately, the views around this table are very different to how things stack up in the polling across this country.
Which is the reason I would take your question and say, even though on paper things look good, why are they not feeling it? And why are they blaming him for the negativity that they feel? You can tell that this is a source of frustration for the White House, and we can debate exactly why this is taking place. But it speaks to the two-speed economy that Mike Wilson was talking about, that we hear about with the front of the bus and the back of the bus when it comes to airplanes. There is a very kind of motley picture of the U.S. economy right now.
It's very hard to land this argument on voters' minds. Inflation, the rate of inflation is coming down when they remember the price of goods before Biden was inaugurated. And I think this story is going to get even more worrisome for the Biden administration. Gasoline this morning averaged $3.66. We're close to $4, and it's not even peak summer driving season. This is going to be a challenge.
This is far too serious. If TK was still here, he would love the following story. Let's leave behind America for a moment and go to the UK. In London right now, at least 2 horses are on the loose in central London. The horses reportedly from the Household Cavalry, which works at Buckingham Palace. They're tracking these horses down.
I've seen those horses.
You've seen that?
I was about to
Beautiful
say,
horses.
is there a horse cam? Sort of like the airplane
We should try
cam?
and find. I'm sure someone's done that.
And we could put it just sort of like on the little
big
down
Jet
here.
TV on
Yeah,
YouTube.
totally.
Watch
Exactly.
the planes land.
We did that all day.
The trainers
Chasing the
take
horses.
them out in Hyde Park, and you can go running like right next to the horses. It's fantastic. But a little scary, I think, if they're on the loose.
I'd love the backstory to all of this. That's the latest from the United Kingdom. Super serious stuff. Let's get you updated on stories elsewhere this morning. Here is your Bloomberg brief. Let's kick things off with Visa. Shares rising in the pre-market after the credit card company's earnings topped Wall Street estimates. Adjusted net income for the fiscal second quarter rose 17% to $5 billion. In the US, where Visa gets more than 40% of its revenue, credit card spending grew over 6% from a year earlier. The earnings follow last month's news that Visa and MasterCard are now allowing US merchants to charge consumers extra for using credit cards, a move retailers say will save them at least $30 billion over 5 years. And Netflix is doubling down on its global ambitions. Bloomberg's Emily Chang speaking to the company's chief content officer about the strategy.
Latin America has had a rich history of storytelling. So many great movies and TV shows, and there's great creative ecosystem there. And what's been great is just to see it continue to grow and to continue to expand the variety and quality of what we do. And that means local creative executives and local production executives, and really having people on the ground who speak the language, who come from the culture, and to really work locally in that community. And that's, taking time to build and grow and have that, maturity in that market that way for us.
You can watch more of that conversation, Emily's interview, on the circuit on Bloomberg TV, streaming at 6 p.m. Eastern Time, and Bloomberg Originals streaming at 8 p.m. Eastern Time as well. We all hope you're enjoying the series so far. Up next on the program, Mag 7 earnings in full swing.
The next few weeks, this is a get out the popcorn moment for tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity.
That conversation coming up next, live from New York City. This is Bloomberg. Stocks on the S&P 500 a lift here by 0.1%. There is one single name dominating the conversation. You know that name so far. It's Tesla. It's the name dominating the conversation so far this morning, at least. We're up by 11.6%. A little bit later on this afternoon, we'll be talking about Meta. Under surveillance this morning, Mag 7 earnings in full swing.
It comes down to earnings. And I think the next few weeks, this is a get out the popcorn moment for tech. And you're going to see chips, AI revolution, enterprise, consumer on the digital side, I think Google, Meta, and others. I think this is really going to be a flex the muscles moment for tech. So my view is, no doubt, white knuckles, many yelling fire in a crowd theater on tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity.
Here's the latest this morning. The stakes are high for big tech, with Meta earnings due after the bell today. Alphabet and Microsoft reporting tomorrow. Meta shares up about 40% on the year so far, following a stellar fourth quarter. Brian Wazer of Madison and Wall writing this: high single or low double-digit rates of growth for digital advertising are likely to persist. The huge, capital letters, thematic issue will relate to the AI-based ad tools that Meta and Alphabet have launched. Brian joins us now for more. Brian, let's start with that launch. How important is that?
I mean, it's massive.
What is it?
Well, okay, so you've got two main products. There's one called Advantage Plus that Meta has, and then there's Performance Max that Google has. I mean, they went from nothing, Meta in particular, from nothing to $10 billion run rate, $2.5 billion, in the third quarter alone. They haven't disclosed a subsequent number, but it's a massive shift in terms of how much revenue they're getting.
Can you tell me what it does?
It just automates everything. It automates the creative, it automates the placement. You just set it and forget it.
So how much are we looking at a much stripped down staff? Basically, are you expecting some sort of mass layoffs in addition to everything they've already announced?
Yeah, I don't think that happens because I think people find new ways to add value to the process. But the point is they collect more revenue. The money is there, right, in terms of what the advertiser's willingness to spend is. You plow more money into engineering, more money into data centers. If you're the marketer, you spend more money into other forms of building ideas and prompting. I mean, AI still requires people to know how to use AI. So it's not like it's not massive labor changing.
So there are a lot of questions with Meta. Usually people are looking at it as an advertising story. There's a question of just how much share they're gaining. And this year it's going to be very much about whether they want to bid for TikTok and what they expect to see in terms of ads from that. What do you expect to hear on that?
Well, I think a lot of people are going to wonder about TikTok. I don't think we'll hear anything about it. First of all, my view, I think when we keep speculating about who's going to buy TikTok, my bet is that the Chinese government won't even allow them to sell it. So I think you're more likely to see an exit of the market. The question is really what happens to all the $6 billion last year, let's say, of ad revenue that was going to TikTok and maybe $8 billion this year. That money will get redistributed, right? Some of it will go to Meta, some of it goes to Snap, some goes to YouTube.
But I think that they'll look about how they can make products that capture the revenue, a disproportionate share of that revenue.
But isn't Meta in the best place to bring in those users? Because you already see TikTok videos, basically hand-me-downs, live on Instagram.
They're in a really good place for it. But you have to remember that so much of TikTok is video-based, so YouTube's in a really good position for that too. Snap also really good position because it's a similar audience.
I also want to ask you about advertising when it comes to China. RBC is talking about potentially it can wane in China, and this is where they have this incredible demand in terms of the advertising. Do you see that? How difficult is that going to be?
Well, let's clarify. You mean Chinese marketers advertising abroad, which is a thing I've been harping on for a decade. It's hard to say. I mean, the weaker the Chinese market gets, the more that manufacturers there focus on markets abroad. It's a negative correlation between economic activity and advertising. This flips the conventional view about advertising and economics.
What does the death of TikTok look like? Can you walk us through that? What would it look like? Do they just do this through the App Store? How does this actually take place?
We can look to India, right? This happened already, right? You literally one day it's just no longer available. And new
but
things
people
pop
can
up.
still use it, even though it's no longer available.
That's my understanding, but I don't really know. This is sort of how do you tell the app stores to stop supporting it? The second you need an update, it stops working, right?
Which raises the question of how they're going to capitalize it and the products that they might come up with to try to get some of those eyeballs. I am curious about the advertising picture, when that often is a sort of macro call on how confident they are about economic strength going forward. Does that still apply?
No. Okay,
why?
No, because, I think that there's these old rules of thumb that were informed largely by a predecessor who I replaced, worked throughout the second half of the 20th century. He basically taught everyone how to think about advertising. And what he taught everyone in the 1950s, 60s, 70s, 80s, 90s was correct, that there was a very direct relationship between economic activity and advertising. But it's kind of falling apart because you have this cross-border activity for starters. The other thing that people don't appreciate, e-commerce-based marketers spend $4 for every dollar of revenue relative to what a traditional retailer spends. For every dollar of revenue they spend on advertising, the e-commerce-based companies spend 4 times as much. So as the economy shifts to digital, there's greater ad intensity. And that's another factor that kind of distorts this relationship.
I have to go here. The chain, Mark Zuckerberg's chain. Because it goes to this question.
He's trying it out.
Well, he's trying it out. It has a prayer message written on it that he wants to sort of pass along, that he reads to his kids at night, and he's starting his own fashion line. I guess I'm going to this point of the cult of personality.
Yeah.
And the questions around personality, and some of these founders of these companies, whether that's an attribute or a deficit or detriment going forward.
Attribute.
Okay.
Oh,
so
yeah.
even for Mark Zuckerberg, who has, there are people who might see the chain and they might really want it, and there might be people who see the chain and say, okay, it's kind of a, bit of a parody of
Vibes matter. I mean, at the end of the day, whether it's politics or advertising, especially advertising. Now, you're not going to get a better AI-driven advertising campaign because Mark Zuckerberg has a more fashion sense, but keep in mind, what really matters, back to the whole, what do people do in an AI-driven advertising world? There's still a subjective choice about why do you allocate more money to Meta versus Google?
Personality matters. I agree with you. Mark Zuckerberg has not got a fan in Donald Trump. Can we finish there? What does that look like if Donald Trump goes back into the White House? It's pretty clear. He can't stand the guy.
I mean, I don't think it'll really impact advertising in a meaningful way. I mean, at the end of the day, it's
Does he have the power to reverse the TikTok decision? Would he put that back on the table? Would he push Congress to reconsider everything? I'm just trying to work this out, what this actually looks like. How much power does he have?
I think the bigger issue is going to be what happens to the rest of the advertising industry. So, for example, broadcasters, right? TV network owners. What kind of regulatory latitude do they get? Because, frankly, I don't want to say they've given up, but they haven't done anything near as aggressive moves as they could take to become a more powerful player with respect to advertising in this world. Could they be loosened up? But again, Lena Khan probably stays in the FTC, no? In which case, maybe nothing happens.
Do you think if Trump wins, she stays in the FTC?
I don't know. Doesn't she seem to be satisfying what...
Well, his potential VP pick likes him, yeah.
Yeah, there's a lot of Republicans that agree with what she's doing. Brian, thank you, sir. Brian Waiter there of Madison and Wall. Meta coming a little bit later following Tesla yesterday afternoon. Coming up next on the programme in the second hour of Bloomberg Surveillance, we'll catch up with Laurie Heinel of State Street, Henrietta Trays of Vader Partners, Bloomberg's Brooke Sutherland, Mike Schumacher of Wells Fargo. Mike Schumacher's got some strong thoughts on this bond market. The Fed is easing soon playbook. remove it from your desk and put it on a distant bookshelf. He does not think those cuts are coming anytime soon.
Which is the reason why you have this big push-pull, and it just takes one weaker than expected S&P Global PMI print for people to go back to the rate-cutting story. And then, does that reverse when we get something else?
We'll talk about supply as well, just for Bramo. Strong 2-year yesterday. More supply coming a little bit later. Bond yields higher by 3 basis points. The 10-year 464, the 2-year up by 3 to about 494. From New York, this is Bloomberg.
All of the things that we would look at from an early cycle perspective are just not there.
I think the big driver here is, does inflation come down as much as we anticipate?
Pretty convinced that inflation is not returning to 2% in any kind of stable, reliable way.
Overall, inflation is just going to be more elevated than we thought.
And that's the big question for us right now, and I think for the market. Is what we've seen inflation that's sticky, or is it truly reaccelerated?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Big tech earnings underway. Tesla behind us, in front of us Meta, then onto Google and Microsoft. Next week Amazon, then onto Apple, Nvidia later on in May. From New York City this morning. Good morning, good morning. Your equity market positive by 0.1%. Tesla in the pre-market absolutely flying, up by more than 12% in early trading, up by about $17. The latest from Dan Ives, bit of a price target cut, down from 300 to 275. But he says this, Bramo, in a much needed call, Musk stepped up as the adult in the room.
Which is exactly what you expected him to say at a time where a lot of people are saying tone matters for someone who is thought of as somewhat of a genius, but also pretty unpredictable when it comes to performance. The key question for me is, how much does this set up this earnings period to be more of a tell me rather than show me, right? We were thinking this is going to be a show me quarter for a lot of big tech. It seems like tell me is just good enough for Tesla.
Is that carrot dangling in front of you right now a carrot or a mirage? I guess we're going to find out in 2025, because the low-cost EV apparently is coming to you at some point in 2025.
Elon Musk was asked about this a lot, and he continued to brush off these questions, and he said more on that August 8th. And I thought he was just obfuscating, because this is what the market wanted, and he wasn't prepared to go in all those details because he really had this Hail Mary idea of the robo-taxi. But Pierre Ferragu said, well, if you have an iPhone and you're prepared to launch it, why would you spill the beans and give those details away? So potentially we will learn a lot on August 8th, which is why the likes of Dan Ives are saying dark days potentially behind us, and we're looking forward.
We'll see. We'll see if this puts a floor under this stock, because this stock has had a terrible year so far. Coming into these numbers, down by more than 40%. We need to talk about the latest down in Washington, D.C. as well. It was almost unthinkable a few months ago that we've actually come to an agreement on foreign aid for Ukraine, Israel and Taiwan. The number $95 billion aid package getting through Washington.
It's getting through Washington. When the president signs it today, he did insinuate last night in a statement that he will make a speech to the American people. Already what we've heard from officials is that they already been preparing, especially for Ukraine, to get that ammunition and those weapons out the door, because right now Ukraine is suffering deeply. What you hear from Zelensky and Ukrainian officials on the battlefield, and they think this next aid package can change.
It also opens up the door to what's next, right, in terms of the discussion points heading into the election. This was a big one. This is really important. Come together, do something. Okay, they got that done. You got to fill, 6 months now of rhetoric? So we have to figure out what's going to be the leading story, because that seems like that's the way of the moment right now in Washington, D.C.
Well, when it comes to a budget, they're just going to punt that. Everything they potentially have to do before the election is going to be kick the can down the road. And it's just going to be a lot of electioning. It's an election year.
Electioning. Okay, lots of electioning coming to a TV set near you over the next 6 months or so.
Wonderful.
Thank you. Equity futures right now on the S&P 500 positive by 0.1%. The stage is set as follows. Going into Meta earnings a little bit later. Yields are higher by 3 or 4 basis points on a 10-year 463.55. Coming up this hour, we'll catch up with Laurie Heinel of State Street, with stocks building on 2 days of gains. Bloomberg's Brooke Sutherland reacting to Boeing earnings out a little bit earlier, a little bit later this morning. Mike Schumacher of Wells Fargo not expecting rate cuts anytime soon. Look out for that conversation a little bit later. We begin with our top story. Stocks bouncing back. Tech driving the S&P 500 to its best day in 2 months. Laurie Heinel of State Street with a warning right in this. Equity markets will remain challenged with continued influence of still high rates, stubborn pockets of inflation and mixed economic data. Overall earnings growth is improving, but individual sectors are vulnerable. Laurie joins us now for more. Laurie, is this a scream to buy bonds and buy bonds right now?
Well, hardly. We still think that there is room to run in equities, particularly U.S. equities. Earnings continue to come pretty good. But it also means that we're holding elevated levels of cash, in part because we do think that there's value there when you have interest rates where they are. But also we want to retain a little bit of dry powder so that we can capitalize if we get more pullbacks.
We got a sense of economic weakness yesterday, just a little sense of it, but it was enough to really push into a bid into the bond market. Do you think that PMI is actually worthy of giving a double take? Would you put much weight on it, what we heard yesterday?
Well, as you know, our view has been that we actually think that the inflation boogeyman is more or less contained. Now, that doesn't mean that we're going to see, consistent 2% levels of inflation anytime soon. But we're really concerned about the fact that the Fed remains so focused on data by data by data, and that there's a lot of noise in the data right now, and actually markets are having the same sort of reaction. So we're not hanging our hats too much on any one point of data, but it's really about trend lines. Where do we see the trajectory going, and is it durable?
One thing that you said was that you have higher than normal cash holdings right now at a time where you do have a relatively high rate for that investment. Are you worried about reinvestment risk? Are you worried about the idea that if that weakness that makes you less optimistic about risk assets comes through, that the Fed would cut rates and would actually make it less attractive?
Well, certainly reinvestment risk is always on our mind. And as you know, our forecast is that the Fed is actually going to cut this year, and they may cut as many as 3 times or perhaps move for 100 basis points or so. But what we also believe is that it's going to be more elongated than what market participants thought just 6 months ago. So we've seen the number of rate cuts come down pretty dramatically. We've seen forward rate expectations rise. So you actually are getting paid to hold cash. We don't think that the amount of cash that we're holding is, particularly high. I mean, 7% is a nice position, but it's hardly going to, take away from the core portfolio. But the other thing is we do think we'll have more time to reinvest that cash over time than we thought even at the beginning of this year.
So how much of a pullback in equities before you start seeing that as attractive?
Well, certainly we'd like to see another 5 or 10%. Those are the sort of levels that give you encouragement that you're going to have a better risk reward. We don't expect to see that in the near term, in part because we think earnings are going to come through pretty well. But of course, there's a lot of volatility out there. Equity volatility has been heightened more recently, and we have actually paired our overweight to equities as recently as early this week.
Given all this volatility, I know you hold a modest position in gold. What would it take for you to want to sell that?
Yeah. Well, first of all, some of the volatility to come down. I think one of the interesting parts about our position in gold right now is it's not necessarily driven by the typical reasons that you allocate to gold. Normally you think about deflationary environments, inflationary, hyperinflationary environments. Those are good places to hold gold as a diversifier. Rather, part of our positioning right now is that gold is one of those diversifiers that is still zigging when other things are zagging. We've seen heightened stock bond correlations over the last couple of years. So gold is one of those positions that actually gives us an anchor. So what we would be looking for is more normalization in the correlation across equities and fixed income.
Lori, what do you give this insatiable demand we've seen in gold and this rally we've seen in this asset?
Well, interestingly enough, one of the biggest purchasers of gold in here has been central bankers. So there is a kind of other dynamic that's going on right now, but we see it's a bit of a momentum trade. And so we do think it has a little bit further to run. So again, in the context of what's going to move differently from other parts of your portfolio, gold gives you that really interesting ballast right now.
Laurie, we had a guest on yesterday. In fact, it was Mike Wilson of Morgan Stanley, who was talking about concerns about the deficit. Not alone, we've heard that a few times, and connecting the dots from that to gold. How much weight would you put on that?
Well, I think it's less about the deficit per se and more about this idea that, the dollar likely will go lower at some point in time. Now, again, typically you don't see the kind of gold run that we've seen when you have a strong dollar environment. But a lot of people, including us, are a bit skeptical that can continue. Now, in the short term, look, there's a great bid on the dollar in the short term. Economic uncertainty creates that. Concerns about, volatility because of 2 wars that we've got going on. Concerns about, other central bankers moving quicker than the Fed. And so that sort of puts a bid under the dollar. But longer term, we think the next trend in the dollar is definitely lower. And that should, again, continue to buoy gold.
Is that because you think there are limits to that central bank divergence story that so many people have piled on in the last few months?
Well, it's not that there are limits, but it's a question of sequencing, right? So, historically, the Fed has been one of the first movers from a developed market standpoint in terms of reducing rates. And it's likely this time around that won't be the case. So again, that gives you a bit of a dollar bid because you have higher interest rates, relative interest rates compared to other parts of the world.
I was really interested in Lori Calvasino. She came out of RBC Capital this morning with a report about some of her industry analysts and how 73% of those in the United States think that the U.S. election in November is going to be relevant to their industries. How are you figuring out some sort of thesis, investing thesis, at a time where there is this degree of uncertainty headed to markets later this year?
I think that's the $10,000 question, right? And I think, first of all, you go back to first principles, right? So earnings growth does drive equities. So where are there earnings that are likely to come through, where are earnings expectations going to be met? And so the U.S. continues to be the best looking house on a fairly bleak looking street. The second thing is hold higher levels of cash. That helps you on the volatility level, helps you with the diversification. Look for the diversifiers like gold. And then, as you say, I think industry by industry, there will be potential repercussions depending upon which candidate actually ultimately becomes president. And so if you look at things that have been sweet spots, Inflation Reduction Act spending, CHIPS Act spending, some of those things may be scrutinized by the next administration. So I think you do have to look industry by industry. The problem is it's a little early for that because we don't really know how this thing is going to play out.
We've heard that a few times too. Can we just finish on tech? Laurie, we get Meta later on today. As you know, a lot of people have just piled in 7 names into one theme, Mag 7. Story kind of worked last year in a big way. And then this year, things started to break down. Laurie, what do you think is the best way to think about those big tech names?
Well, first of all, you have to take them one at a time. You can't just lump it all together and say, let's just buy those 7 stocks and call it a day, because as you noted, wild divergence. But we've always been more in the camp that we thought that you don't want to chase those names even collectively. Have a much more diversified portfolio. We do think that as the market continues to see its legs, you'll see broadening out in the market, and that's going to benefit investors.
Laurie, appreciate your time this morning. Laurie Heinel there of State Street, following earnings from Tesla. Later on this afternoon, we'll hear from Meta. Then on to tomorrow, you'll get Google and Microsoft. Next week, Amazon and Apple. The end of May, near the end of May, May 20-something. I think May 22nd, you'll hear from Nvidia. Equity futures on the S&P positive here by 0.1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Ryanair CEO Michael O'Leary weighing in on Boeing's management crisis. O'Leary saying the plane maker needs to focus on leadership, continuity, as it seeks to stabilise its business.
We're seeing optimistic signs. I mean, we've seen aircraft now being pulled from the hulls, being moved from Wichita to Seattle, but without any defects being carried over. I think that's a good sign. It'll speed up the manufacturing process in Seattle, and I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
Boeing is set to report earnings in just under 30 minutes' time as it faces ongoing regulatory scrutiny. That stock is up at a pre-market by a little more than 1%. Elsewhere, talks to resolve a standoff between pro-Palestinian demonstrators and Columbia University officials have been extended after a deadline expired at midnight. The Columbia Spectator reporting that the 2-day extension came after significant progress in discussions. Student representatives agreeing to 4 commitments, including cutting down on tents in their protest encampment. House Speaker Mike Johnson is set to meet with Jewish students at the university a little bit later on today. And finally, Kering shares falling to their lowest level since 2018 after the luxury group warned of a profit plunge in the first half of the year. The company blaming slumping sales at Gucci, its biggest brand. Shares are down 20% so far this year compared to gains elsewhere in places like LVMH, which is up something like 10%. If you missed it earlier, an absolute clinic on what Gucci is going through from AMH a little bit earlier. Do you want to repeat that clinic?
At this time, there's a lot to dissect here.
The design problems, the obstacles going forward.
It's a different creative director. It's a new vision.
A new vision. What is that vision now?
It's definitely a little bit more sleek. His first runway show was a gray overcoat. It wasn't the extravagant, in-your-face, loud fashion of Alessandro Michele. It was more sleek. Think vintage Gucci.
Okay.
And the consumer base is different. They need to shore up some new clients.
The numbers out of Gucci just absolutely terrible. Sales of Gucci down 18% in the first quarter, held back by China. Up next on this program, less on Gucci, less of that stuff. The Senate passing the foreign aid bill.
After more than 6 months of hard work, many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you.
That conversation is just around the corner. Live from New York City this morning. Good morning. The bounce continues. 2 days of gains on the S&P 500, up just a little bit, up by another 0.1% on the S&P. Yields drifting higher once again, up by 4 basis points, 464.17. Under surveillance this morning, the Senate passing the foreign aid bill.
After more than 6 months of hard work, many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you. Failure to pass the supplemental would have been a gift to Putin, to Iran, to Xi, and hurt America politically, militarily, economically, and culturally.
Here's the latest. President Biden set to sign a $95 billion aid package for Ukraine, Israel and Taiwan after the Senate passed the bill just last night. Biden's signature will also start a countdown on TikTok, the social media app facing a possible ban in the US unless its parent company ByteDance divests within 270 days. Henrietta Trays of Vader Partners joins us now to break this down. Henrietta, before we race off into the detail, I just want to sit on this just for a moment. We've talked so much about the division down in Washington. Only a few months ago, some people thought the prospect of this happening was almost unthinkable. Just how united did Washington become on this issue in the last few months?
They gained, I want to say, 8 votes since February from the Republican Party, who had been so opposed to providing the aid to Ukraine, Israel, and Taiwan. This is really a case of members wanting to be on the right side of history. You know, last week when Speaker Johnson said, hey, go into the sit room, look at all of the foreign intel, look at the data that we have backing this up and why we need aid to Ukraine. We need America to be strong against Putin and Xi and Iran. And that is exactly what the members decided to ultimately deliver. I think this is a testament to the foreign policy arm of Joe Biden's career in the Senate as president, obviously Chuck Schumer, but in no small count, it's Mitch McConnell who wants this to be his legacy, which is something we've been hearing from staff for 7 months since the October 7th attacks in Israel and well before that in Ukraine.
But Henrietta, this got through without border policy, which Republicans were basically promising their caucus that we would make sure we would do. Where does that leave that potential legislation? Or is this just 100% become an election issue and no one in Congress is going to work on it until maybe next year?
Congress is definitely not going to be able to do anything on the border. Republicans had their chance. They decided it wasn't good enough. They let the perfect be the enemy of the good and all the cliches that we hear from Lindsey Graham repeatedly on issues like this. And we haven't passed immigration reform in decades. I still remember 2013 when we came so close. They do not have the ability to get to yes on immigration. But the administration is planning a series of executive orders on border policy, which we'll see potentially as early as next week. So I expect that to be the bulk of what we do on foreign policy, on border security in this Congress.
And of course, that's going into the election. We have a new poll out this morning which shows that Biden bump he had following the State of the Union has evaporated. He really only has control right now of Michigan, and it continuously comes back to the economy, especially inflation. What is the messaging from the White House going to be? Because it's not landing on voters.
You know, the economy has been a weak point for President Biden for many years now. One thing I'd really point into your polls, which I think have an incredible margin of error of just 1%, you know, speaking to the testament of how thorough your polls are of the swing states. Michigan is an interesting one. Obviously, President Biden has made huge efforts to get with the union groups on that. He got another endorsement today. But Kennedy did get on the ballot in Michigan, which is potentially going to be a problem for the Biden team and the Trump team. But when it comes to the economy, the president has had an underwater dearth with women voters, female voters, specifically because of their exposure to inflation and the cost of household goods and gas prices, which are a disproportionate share of where money is spent in America from the women of the household. And that delta is potentially being superseded by the abortion issue, which for the first time in your poll is now a major issue, very important to a majority of voters in those swing states. That includes Democrats, independents. And what we saw from 2022, if we want to learn from something beyond just the polls, the actual boots on the ground, that issue has a history of superseding even the economic issues and inflation, as we saw in 2022, when inflation was even higher at 9.1%. So I do think that it is going to be a situation where Biden keeps having to tout the state of the U.S. economy, which is by all accounts strong, which is why the Fed is struggling to, cool it enough to bring inflation down. But really getting that message across, I think something that's occurring is they're trying to two-step it with abortion. I'd like to see where immigration falls in the polls when I get a chance to read a little deeper into it. That's also something Republicans want to seize on, but the economy continues to be paramount.
Annmarie, we were saying that now that this $95 billion bill was passed, there's a question of what next? What gets done before the election? Annmarie well said, electioning will probably get done, not a whole lot else. You talked about the potential for some sort of single executive actions on the border issues. What about tariffs? What about other issues that might come to the fore, including from the FTC, that very much are in line with what Biden has been talking about?
Oh, yeah, I'm finally expecting for tariffs and trade to be front and center. Ambassador Tai was on Capitol Hill last week in the House and the Senate side, and there were some major announcements. 3 times higher steel tariffs, which is only about 2% of U.S. imports, so don't expect that to be a major mover for steel prices in the U.S., but directionally and from a sort of messaging standpoint on China, very important. And a new Section 301 investigation into shipbuilding, which is an area that the United States is way behind on and China dominates with, and then a coordinated effort with Mexico, potentially also Canada via the new USMCA that Ambassador Tai was integral in getting passed during the last administration, could be used to look into electric vehicles, their import from China on the component side, and sort of preemptively getting in front of that entire sector. So I think a lot of activity on trade. And then, of course, we are eagerly awaiting a conclusion of the Section 301 review, which covers the $370 billion worth of tariffs that are currently in place. And by the end of next month, Ambassador Tai will announce which and whether any exclusions that were agreed to in the last year will be extended. So lots of movement on the trade front. But to your point on Congress, don't expect anything. They're going to be gone campaigning for the rest of the year.
When it comes to the trade front, you mentioned steel, I think Pennsylvania. You mentioned potential EVs on Chinese tariffs. I think of Michigan. What lever could Biden pull before the election to shore up votes in Wisconsin if he has to keep the blue wall, which Mario Parker, our colleague in Washington, says he has to keep the blue wall to win?
You have to keep the blue wall. You really want to see the heartening part of the data for the Biden team in your poll this morning is Michigan, where he continues to maintain his lead, even though he's underwater everywhere else. I would also say the primary vote in Pennsylvania last night is really interesting. Nikki Haley, who hasn't been on the ticket for months now, got 17% of the vote. So I think what Biden is going to do is try to continue moving forward with the steel workers. Again, that 3 times higher steel tariff is something that he is calling for that speaks directly to the steel workers. And what we know about the unions, the Teamsters, the steel workers, and all those groups is that they will go to the mat to get their 250,000 members in any individual union to vote in the direction that they're advocating for. So I think that Biden is really taking that labor message to heart, which is integral in Pennsylvania, Wisconsin, Michigan, and the whole Rust Belt.
Henrietta, you are one of the best. It's great to catch up with you. Henrietta Trace there of Vader Partners, breaking down the situation with our polling and what we've seen overnight in the Senate. AMH, this is something that Henrietta's done a brilliant job of over the last few months. Just how deep is that pool of people who just have not decided what they will do come November?
There are a lot of them. And something else in our poll that I find striking is the fact that Biden's 6-point deficit across the swing state even wider than that of Democratic congressional candidates. So can you see these split ticket individuals say, actually, we don't like Biden, but I like my Democratic congressman or woman, and I'm going to vote for them. So when it comes to these double haters, the issue is, where do they go, or do they split their ticket and potentially give the other side their presidential vote?
It's going to be a fascinating 6 months ahead. Equity futures right now on the S&P 500 positive by 0.2%. Tesla doing nicely in the pre-market. More earnings still to come. And a little bit later, you're going to hear from the likes of Meta after the bell. Before the opening bell, you're going to hear from Boeing. Earnings dropping any moment. We'll catch up with Bloomberg's Brooke Sutherland, who joins us next to react. From New York City, this is Bloomberg. Coming off the back of the biggest one-day gain going back about 2 months. 2 days of gains into today. Equity futures positive by another 0.2%. A little bit better on the Nasdaq, up by 0.6. Supporting that story, Tesla out overnight, up in a pre-market by double digits. We'll talk about that name in just a moment. Let's talk about the bond market. Lots to discuss. Solid 2-year issue just yesterday at the front end of the curve. $69 billion worth. Later, huge numbers. $70 billion of 5-year notes coming to market. Yields are higher going into it by a single basis point on a 2-year, 493.93. On a 10-year, up by 3 or 4 basis points, 463.76. What was interesting, almost amusing, was how encouraged people were by the softer PMI we got yesterday morning.
It confirmed the belief that some people have that data is going to weaken, and that was enough to give them confidence to go into that 2-year auction and absolutely hoover it up, right? I mean, this is essentially what people were worried about, is if you get a weak auction, how much does that filter into the rest of the market? What's interesting to me is just how much that's the tail that's wagging the whole market's dog, right? Basically what you have is stocks willing to rally if bonds rally. But if bonds sell off, stocks don't know what to do. So there is still a bias right now underpinning the market of a soft landing and, frankly, of a pretty bullish sentiment.
That's the market. We're tracking earnings this morning. Boeing has just dropped. We'll work through the details and we'll bring them to you when we get a clearer picture of what the company's telling us this morning. Let's turn to foreign exchange. Story in euro dollar. Dollar yen looks like this. We're negative by a tad at 1/10% at 106.85. Dollar yen 154.91 came really, really close to 155 overnight. We're up by 0.05%. The threat of intervention, I don't know, can you make the argument it's hanging over this currency pair when we went through 152, 3, 4 and approached 5 in just a few weeks?
I mean, arguably you could say that people are questioning their ability to interfere. At this point, you have to wonder, okay, is it not just at 160 because of the threat of interference, right? I mean, the bar has gotten reset so many times. Right now, what I'm looking at is how much is the Bank of Japan and, frankly, potential foreign intervention waiting for weak prints in the U.S. to do anything, because this is a fundamental story, not one particularly of whether they buy the yen or not.
Just a little more yen weakness on the screen today. Out of surveillance, your top story, shares of Tesla flying in the pre-market. The company accelerating plans for a cheaper EV model, which could be available by the end of the year. The announcement overshadowing worse than expected revenue and profit. That name is positive in the pre-market by double digits. Elsewhere, in Washington, President Biden set to sign a $95 billion aid package for Ukraine and other allies, allowing arms shipments to Kyiv to resume within days. Biden's approval also starting a countdown for TikTok parent ByteDance to divest the social media platform within 270 days. I guess you can say my work here is done. I've done my bit. And finally, let's turn to Boeing. Earnings crossing just moments ago. First quarter revenue beating Wall Street estimates. The CEO, Dave Calhoun, saying the company is likely to deliver its 737 and 787 inventory by year end. That stock is higher. Initial reaction, we're up by almost 3%. Brooke Sutherland of Bloomberg Opinion joins us now for more. Brooke, you've had a few minutes to go over this one. What stands out for you?
I mean, I think what's really striking is you look at in the quarter, those commercial airplane deliveries were down 36%. And that just speaks to how slow Boeing is going right now as it tries to finally get its arms around its quality control issues and make sure that the FAA is satisfied. But if it's not delivering planes, then it's not collecting cash on those aircraft. And that's why you're ending up with this negative free cash flow in the quarter of about $3.9 billion. Now, that could have been worse, quite frankly. And it's certainly positive to hear Boeing talking about being able to clear out its inventory by the end of the year. But I think that remains a bit of a prove it story. At this point in time, we still need to see the results of Boeing's action plan in response to that FAA ultimatum to come up with some sort of plan to finally, put an end to these quality control issues. And I think the FAA is really going to be the gating factor here in terms of Boeing's ability to meet those goals.
Demand isn't a problem. They're talking about the new net orders, 125. Demand hasn't been a problem. It's never really been a problem over the last few years, Brooke. It's quality control, to your point, and now it's about production, their ability to meet that demand. Brooke, has it interested you at all that demand hasn't fallen off in a material way, given how much this company has been in deep water over the last few months?
Well, I mean, I think if you look at its market share relative to Airbus, it is losing. And Airbus has built up a pretty substantial lead, particularly in the narrow body market. And so in terms of that competitive dynamic, it is much more lopsided than it was just a few years ago. But the reality is you have a duopoly. And if you are an airline operating in either Europe or the US or really any part of the Western world, your only choice is Boeing or Airbus. And it's not in the airline's interest to put all of their orders on Airbus in terms of pricing dynamics dynamics and also in terms of just being able to get those airplanes, because Airbus is sold out well into the next decade. And I think that's, if you look at Wall Street analysts, and a lot of them are still very positive on Boeing stock, not because, the current situation is so wonderful, but just because the reality of the aerospace market is that demand is going to be there for Boeing. Boeing is not going to be allowed to fail. It is the biggest U.S. exporter, and the airlines and much of the world really depend on this company to finally figure out what is going on and be able to hand over airplanes that are to the quality that airlines expect.
But can it turn a profit? Boeing shares are down 35% so far year to date, which is a reason why a 3.2% pop looks significant, but in the scheme of things, maybe not so much. Brooke, what optimism can you glean? Just simply that there could have been a worse negative adjusted free cash flow number, or is there something else, either a NASA contract or some sort of sit-ins of safety patrol that you've been hearing about with certain employees?
I think in terms of the question of when will they turn a profit, I don't know if that's the right question right now. And I don't really think that investors want to hear that from Boeing, which sounds weird to say, but the best way forward to rebuild profitability and free cash flow is to get to the bottom of these quality control issues. And that happens by going very slow, being very meticulous, getting in on the factory floor, figuring out where the problem points are and really solving them one by one. And I think the optimism is around the fact that Boeing seems to finally understand that. Now, you could argue that they probably should have understood that after the two 737 MAX crises, but they seem to get it now. They seem to be taking it seriously. Of course, they also announced that leadership transition with CEO Dave Calhoun set to step down by the end of this year. We don't know yet who is going to replace him, but they're at least saying the right things right now, which I think is progress.
Honestly, this just rhymes so much with some of the analysis of Tesla that basically the two laggards came out and said the right thing, and that was enough for people to buy into this story. Is it enough for you? Is it basically enough that this is a leadership team that understands that it needs to be saying safety is first, even though literally everybody has been saying that for the past, 3, 4, 5 months?
To your point, yes, I think the bar is rather low here. And like I said, they're in the prove it moment, that it's good that they're saying the right things because they haven't always been doing that. There's sort of been this undertone of, no, we don't have, a culture problem, and this is not some sort of comprehensive issue. It's just sort of one-off quality control issues we have to get our hands around. And they've started to move away from that, which, acknowledging that I think is an important first step. But you're exactly right, that it really comes down to, can you build up a track record where airlines are receiving the quality airplanes that they have ordered and they're receiving them on time. And I think that just is going to take a couple months here, and Boeing really needs to work its way through its issues.
Brooke, where is Boeing when it comes to buying back Spirit AeroSystems, this company they used to own?
It's interesting because I think there's a lot of urgency to try to get this deal done and to bring Spirit back into the fold and help stabilize it. But this has been taking a bit longer. Now, there was some news yesterday that Spirit actually announced Boeing is advancing it $425 million to help stabilize its operations. This is certainly not the first cash advance that Boeing has made to Spirit. It has a lot of its own staff already in Spirit's factories, and that's partly why I'm somewhat skeptical that this acquisition is going to do all of that much to really rectify the issues with Spirit and Boeing's supply chain. But at this point in time, they're still working through their math on that deal.
But what about Spirit's supply chain? Because they also have Airbus as one of their customers.
Right, which is a complicating factor, and this would have been a lot easier, if Boeing had attempted to repurchase Spirit, a decade or two ago. But now Spirit has tried to diversify, partly out of necessity, because it was not healthy for this company to be so dependent on Boeing. And so they do have contracts with Airbus. They also have defense contracts. Now, those are not entirely profitable contracts for Spirit, but they do exist, and those companies rely on Spirit as a supplier, and they're not going to be keen for some sort of arrangement with Boeing that doesn't satisfy their interests as well. And that's partly why this is so complicated, and why some analysts in the past have expressed skepticism about any kind of Boeing takeover of Spirit, just because this is not an easy deal to get done, and it requires a lot of carving up of assets.
Hey, Brooke, appreciate the breakdown this morning. Brooke Sutherland there of Bloomberg Opinion. Boeing, if you are just joining us, first quarter revenue $16.57 billion. The estimate $16.25. The stock is higher in the pre-market by something like 4%. Bramo, I think you're right. Kind of rhymes with Tesla for a few reasons. Here's another one. year to date, absolutely hammered. You can't look at this move unless you look at it relative to where the stock has been over the last few months.
So it raises this question in my head. Is the bar different for different companies, right? Because they've been the two biggest laggards on the S&P 500, are you looking at a bar that is lowered substantially? And even just good talk is enough to get this over the finish line and get a bit of a rebound versus companies that have done very well. And even if they beat expectations, we've seen sometimes an underperformance. Again, it highlights how difficult it is to come with any overarching narrative for this earnings season, even though, we're trying to find those themes. Mike Wilson, I said it best yesterday.
You nailed it, yeah.
Keep humble, keep nimble, keep looking at each story and figure out kind of where each one is going to go.
And Mike said what we've said a million times on this program. You can learn something from the information and how the market responds to it. It makes me think of Apple next week. How low is the bar for Apple next week? The numbers we've seen around this company, down double digits year to date. We've had warning after warning in China. Research outfit after research outfit come out and say how weak earnings are in a second largest economy. How low is the bar going into next week?
Which is the reason why some people are expecting some kind of pop in the shares, including Bank of America. This is the issue, right? What will it take? Is it just sort of rhetoric in terms of either a lower priced model in certain areas, expanding in India? What kind of advertisement campaigns they're going to do in China? Are they going to move away from China? Those are some of the questions I think are going to be really interesting.
Futures right now positive by 0.2%. Let's give an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Gold's record-setting rally this year has left market watchers puzzled, but the answer may lie in China. Prominent figures in the global gold market coming to the conclusion that retail investors on the Shanghai Futures Exchange are helping to boost prices. China is a top gold consumer and producer. The country has a long-standing history of using gold as a savings tool. Gold soaring this year, topping 2K an ounce in the face of headwinds that would normally cap any gains. A second story, the FTC voting to adopt a near total ban on non-compete provisions that prohibit workers from switching jobs within an industry. The Chamber of Commerce vowing to immediately challenge it in court. The legal showdown comes 3 years after President Biden signed an executive order encouraging the FTC to limit non-compete agreements, which affect roughly 1 in 5 Americans. The rule does not apply to existing non-competes for executives who earn more than $151,164 a year in a policymaking position. How did they come up with a number like that? Where's that from?
Gotta be accurate.
I mean, come on. How did they come up with that? And your final story, the NBA's exclusive negotiating period to discuss a new broadcast deal with Disney and Warner Brothers has ended. Opening up the sport to potential new bidders, the NBA will continue to negotiate with current partners, but could look to expand its broadcast deal to include streaming-focused services such as Amazon or Apple. The league's current 9-year deal is worth around $24 billion, with the NBA looking to double that this time around. I just want to know what channel to go to for what sport.
It's we know what you want.
Doesn't matter.
So you just want a bundle.
What it is.
You want it to go back to the future, which is basically have a bundle.
Just want to know.
Go.
Pick one.
What, do you want it just like a search function?
No. Yeah, that would do.
You think so?
Just the algo at this point should know, right?
Obviously.
Like Amazon
versus Farmer and Son.
Amazon
or
at this point knows everything about it.
Farmer's Wife. Excuse me.
Great show. Great
American
show.
Idol.
Fox. Good show.
Bachelor. I mean, honestly,
you've been watching
fair,
Idol too.
Whatever.
Yeah, there you go.
I don't watch
what
any of this. What are you guys doing on the weekends?
Honestly,
Bramo likes to chill. This is how she chills.
I also look at puppy videos.
Do you?
Oh, totally.
Dog videos?
Yeah, all the time.
True story, okay? Show's going. TK's going off on one. Fiery morning, okay? Bramo's next to me, watching dog videos. Videos.
I can
just
still
to try and calm herself.
Look, it's also resurrection videos of like the dogs that are being found and they're sort of kept up and made into something.
I'm going to plan the night out for surveillance.
TK having too much tang, Bramo kind of losing it a little bit, just trying to, meditate.
We all have our things.
Meditate
we
on puppy
all have
videos.
Our issues.
Okay. Up next on the program, bracing for a hawkish Fed.
Even if you get disinflation, 3-4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates. It's going to take a while to rebuild that confidence.
That conversation on the other side, live from New York. This is Bloomberg. No more of that. Equities on the S&P, positive by a quarter of 1%.
We're going to still go there.
No.
Yeah,
we're
totally.
done. Under surveillance this morning, bracing for a hawkish Fed.
With growth as resilient as it is, with financial conditions as easy and accommodative as they are, there's really no reason for the Fed to guide towards a full cutting cycle at this point in time. Even if you get disinflation, 3-4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates because they've seen a head fake from the inflation data. It's going to take a while to rebuild that confidence.
Here's the latest. Investors are waiting Friday's core PCE deflator for hints about the Fed's path forward. Mike Schumacher of Wells Fargo writing this. Move the Fed is easing soon playbook from your desk to a distant bookshelf. The Fed needs 2 or more, likely 3, solid inflation reports before seriously considering a rate cut. One fine day, the Fed will ease and the market will then price lots of additional easing. That's not today. Mike Schumacher joins us now for more. Mike, fantastic note. Thoroughly enjoyed it. I want to pick up on what you had to say about supply as well, because we've been very focused around this table on the slate through the rest of this week. 2-year yesterday, 5-year today, 7-year tomorrow. Do you think the supply deluge, the fireworks, are in the rearview mirror?
Just about. Yeah, it's interesting. You've got the announcement coming out next week. Should be kind of a snoozer. So I do agree that the huge uptick in supply, it's probably done for the balance of this year, Jonathan, and maybe into next year as well. Depends on the election outcome, but probably 6+ months.
I feel seen. I understand. Maybe some people aren't focusing on the auctions as much as I am, but I do think it's telling that yesterday we saw such a big move in the 2-year yield and, frankly, a successful auction on the heels of S&P Global PMI data. How much, and John brought this up earlier, how much does that sort of give you a sense that maybe the playbook needs to still be on the bookshelf and having, a little bit of a permanent place in your repertoire?
It's on a distant shelf. It's not gone entirely, but I think for now you can set it aside, Lisa. It's interesting. When you look at what's been driving both rate and currency markets, it's expectations for central bank policy. So the Fed, the ECB, take your pick, but that's what the markets are fixated on. You can do regressions until the cows come home, and that's what they'll tell you. You can talk to people in the markets, and that's what they'll say. So 2-year auction, interesting, but to me it's not really a signal event. So I do focus, though, on the huge amount of supply we've seen and think the market's had a tough time digesting that. I agree with that point.
What's the distinction between a Fed easing cycle and just sort of maintenance cuts, or however people want to call it, where you do get a couple of cuts this year, but it doesn't begin this sort of wholesale decline in benchmark rates?
Yeah, so just to trim around the ears, that type of thing. I suspect the Fed would have a tough time doing that. And the reason I say that is that if you think about the FOMC, when those committee members sign up for one cut, they have to assume there will be a bunch of cuts to follow. And my strongest view with respect to Fed policy hasn't changed, despite the backup in rates. And that is that, as Jonathan noted, whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
At this point then, Mike, if that's the case, do you think that the bar has gotten much higher in terms of how weak the data has to be and how many points of data we have to get for the Fed to really embark in a rate-cutting cycle this year at all?
Yeah, the Fed's been burned a couple of times. It kept policy easy for way too long. That's pretty clear. Talked about the pivot late last year. That was too early. That's 0 for 2. Do you want to go 0 for 3, as my colleague Fred Stemp says? Probably not. So what that means is I think the Fed does need to wait. The bar probably has become pretty high. And also, lastly, on that point, Jay Powell wants that first move, whenever it is, to be unanimous vote. He has nowhere near enough votes now to even think about going for one move, let alone a bunch. So the bar is quite high right now.
Mike, let's get to the bond market call. We had Darryl Cronk on the programme just yesterday, and he talked about how flat the curve was outside of the very front end of the curve. Can we talk about some of those levels? The 3-year is basically where the 30-year is right now. The 5-year yield is where the 10-year is. If you're confronted with this situation this morning, if you're an investor, maybe you don't specialise in fixed income, you need to make a choice. OK, I want some yield, some income. Got people screaming on Bloomberg Surveillance about levels we haven't seen in a long, long time. Where do I want to buy across the curve? What are you advocating for, Mike, when you see that degree of flatness from 3 years and out?
Yeah, it's interesting. Right now, I'd say it's premature, Jonathan, to extend out the curve. People, when they want to extend, think about this. They'll say, look, I'm getting a tremendous rate right now in my money market, or just sitting in Fed funds at 533. Why should I take that extra risk? The reason I would do it is if I think the Fed is going to cut pretty soon, and I'm not going to get that lush 533 much longer. Well, pretty soon probably is not anytime soon. So for us, we'd recommend extending out a little bit, going out to, let's say, perhaps a 2-year, but not going all the way out to even a 5-year or a 10-year at this point. Too soon.
What does that mean for credit, Mike, if that's the call for the front end of the yield curve? What's your credit call?
I I think that's one reason credit's held in well. So I'll step out of my lane a little bit and say, investor after investor that I've talked to, I was in Asia last week, talked to a ton of people, and they universally are tired of getting no carry, very little yield relative to their bogey. So any incremental yield to them is attractive. That's what I hear time and again in the U.S. as well. And I suspect that's why people have been so keen to buy credit. They say, yeah, spreads are tight on an historical basis, but relative to what I can get in terms of yield curve, which is negative, credit looks pretty good. So hence the strong bid for credit's persisting.
Yeah, the idea of all-in yields being something like 7 or 8% on average is sort of an anathema, given the fact that we saw 4 or 5% for so many years. Mike, when you zoom out, there's a real question here about what we're going back to. And the argument that you're laying out, that we could stay at these levels of rates for the foreseeable future, suggests that policy isn't necessarily sufficiently restrictive, that we still have inflation under the hood, and that, frankly, there is more strength and more inflation than most people had previously thought. Can you give us a sense of how that evolves over 2025, 2026?
Yeah, the thought from our econ team, and Sarah House does a terrific job on this, is that inflation will come down, but it's going to be a fairly bumpy process. And you've seen the U-turn over the last, call it, 6 months in inflation in the U.S. CPI is running amok. PCE is not behaving terribly well. She thinks the peak in PCE is pretty soon, and then it'll come down gradually. And remember, the Fed focuses on PCE, not CPI. There's a big difference. CPI is super high right now versus PCE for lots of reasons, but it's going to be a fairly slow process. The thing is that the market needs to see a couple of good prints on the data. And we keep telling people it's a market of catalysts, not levels. So you need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum and could be into next year.
Mike, we just have the Senate overnight legislating this deal for $95 billion in basically defense to the U.S. allies. Biden will sign it today. What does that mean in terms of yields for Europe versus the United States?
Yeah, so this idea of defense spending going up is really interesting, and we suspect it's a global phenomenon. So if I were to take a look out a couple of years, I'd say which countries have to increase defense spending? Probably all the developed countries. Who's going to have the biggest delta? Most likely not the U.S. U.S. gets a lot of attention. Certainly the bill it's passing now is front and center. But if you think about the situation, let's say in Germany or in France, where you've got defense spending generously maybe at 2% of GDP, where does that go? 3 plus, 4 perhaps in a couple of years? That's a ton of incremental supply in their markets on top of a lot of extra supply of treasuries. You put it all together, what you have is a lot of extra bond issuance coming to market from these developed issuers. And that to me means that real yields have to be higher over the next 3 to 4 years than they have been in the past. But it's a really topical point. It's key. Yes,
this is a really interesting call. I apologise for jumping in, but I've only got about a minute left on the clock. Peter Cheer of Academy Securities has said the same thing. Now, typically, as an investor confronted with heightened geopolitical tensions, you'd be buying core fixed income. But if you believe it results, if you believe the consequences, higher defence spending, are you making the argument that maybe that trade's not going to work?
Yeah, I think the trade is really twofold. So let's say tensions pick up in the short term. Knee-jerk reaction is people buy treasuries, they buy boons, they buy the short end, the usual stuff. But then as they step back a little bit and say, what does this mean over the longer term? A lot more issuance, probably really going to impact longer yields to a fairly large degree. So it means you're going to see this secular steepening, there we go, can hardly get it out, in yield curves. And that's going to be a big shift. So near term, rates down, front end as well. Longer term, higher yields on the back end.
You finished and Lisa's smiling. Supply starts to matter again. Mike Schumacher of Wells Fargo. Mike, thank you. Appreciate it, Mike. Thank you very much. We've heard that point before from Peter Cheer. I think it's fascinating.
It is fascinating. The issue is then we ask people, well, how much of the deficit's being priced into markets right now? And they say, yeah, it's not that big of a deal. And you see that with every auction. So at what point will it start to matter? Because it is a valid point academically and intellectually. But the market has defied all academic and intellectual arguments for the bulk of the past couple of years.
The last 4 years,
yeah.
I would say, post-pandemic. Still trying to figure this out, aren't we? I know. Coming up in the next hour, we'll break things down with BlackRock's Kate Moore. We'll catch up with retired General Mastin Robson. Tiffany Wilding of PIMCO joining us to look ahead to the data this week and look ahead to the Fed next week as well. Mandeep Singh of Bloomberg Intelligence will be joining us too. That's all coming up very shortly in the third hour of Bloomberg Surveillance. Equity futures right now on the S&P 500 positive by 0.2%. Bond yields are higher by 4 basis points. 464 on a 10-year. The 2-year up by 3 basis points. 4.94 from New York City. This is Bloomberg.
When you look at the relative earnings growth, it's going to decelerate for that Mag 7. And it's going to be overtaken by the forgotten 493.
It's not so much about the earnings results, it's about the reaction of the stock to the earnings results.
When we listen to earnings calls, we're starting to see a normalization in consumer spending trends.
What you are hearing is consumer demand that's held up better than a lot of people expected.
We get 30% of earnings this week. We got to go. We got to get the engine humming here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Earnings season has just started for Mag 7, live from New York City this morning. Good morning, good morning. Equity futures on the S&P 500 positive by 0.25%. Straight out of the gate, out first, we heard from Tesla. Out later, we'll hear from Meta. Into next week, you'll hear from the likes of Apple and Amazon. Before this week is out, you'll hear from the likes of Google and Microsoft. Bramo, what do you want to see from these big players over the next week?
What's the bigger surprise for shareholders? To quote Mike Wilson, the reaction to the response that you get from the earnings reports may be more interesting than the earnings reports themselves. Is the bar set too low or is the bar set too high at a time where these had been outperforming and then saw a bit of a hiccup?
Yeah, to your point earlier in the program, I think Tesla a perfect example of that. Hammered going into earnings, down by more than 40% year to date. On the morning, take a sneak peek of this. We're up by 12% in the pre-market on Tesla off the back of, I'm not even going to say it was off the back of the numbers. I think it was off the back of just a commitment to that potentially, and I say potentially because we really don't know, potentially the launch of a lower cost vehicle, because that's where this market wants this company to be.
August 8th. That's what Tesla's Elon Musk kept saying on the conference call yesterday when everyone was asking, well, tell us about either the robo-taxi or what about this $25,000 car that you're promising? And that seemed to be when shares really skyrocketed. Everyone was talking about, okay, they're finally getting back into plans for a cheaper Tesla model. And yet he said, we'll have more information on August 8th. And the question then remained, well, is he just obfuscating for a reason, trying to give the market a little bit of what he wants? But then Pierre Ferragu made a very good point. It's like an iPhone. You're not going to give too much away before you set to unveil it.
Channel that into later this today after the bell when we get Meta earnings. Those shares are up 40% this year. So they're up almost as much as Tesla is down. How different are the earnings going to have to be to generate the same kind of reaction? That's what I want to see.
Zero conviction on a ton of things. This from Kit Jukes this morning. A tangible lack of conviction in markets. You think? I think you agree, right?
It's so frustrating. I mean, everyone comes on and they come up with a thesis and it's sort of half-hearted and trying to figure out how they're going to edify it. This is a confusing moment, which is the reason why people are talking about the earnings and the specific companies. It's much more comfortable than macro, because good luck getting macro right and then even getting the market call, even if you do get it right.
Yeah, getting the second call right has been tremendously difficult for quite a long time. Equity futures on the S&P 500 positive by 0.2%. There is a lift in this equity market. In the bond market, yields shaping up as follows. We're higher by 3 or 4 basis points on the session to 463.76. The euro a little softer. German business confidence was better, not supporting this currency, still trapped in this range of 106 to 107 at 106.89 and softer by 0.1% on the day. Coming up this hour, we'll catch up with BlackRock's Kate Moore on why this earnings season is crucial for investor optimism. General Mastin Robeson of Academy Securities as the Senate passes Ukraine aid, and PIMCO's Tiffany Wilding on US GDP ahead of next week's Fed meeting. We begin with our top story. Stocks pushing higher, led by Tesla. BlackRock's Kate Moore saying this: after a healthy pullback in equities over the last few weeks, the pressure on earnings and constructive guidance is particularly high. The biggest right tail risk for 2024 is that earnings come in much stronger than current forecasts. Kate is with us around the table. Kate, good morning.
Good morning.
It's been too long. It's great to see you in person here in New York. Let's talk about that upside potential on the big tech names over the next week. How great is it?
So I think the big thing to watch here is not what happened in the first quarter. I mean, we want to see some monetization on AI. We want to see constructive guidance on AI. But I really think it's going to be the tone from management. You guys were talking about Tesla a moment ago, and I think this was the critical thing turning the stock price there, is that it sounds like there's a plan. And I think there's been a lot of good news priced into a lot of the big tech companies. But this is a chance to really kind of show me, what does the rest of 2024 look like? How are we thinking about AI spending? What does customer demand look like? And then we can go from there.
Are you saying we need a C-suite therapy session on earnings calls?
Yeah, we need to see a constructive, happy face from all of these leaders. By the way, a funny bit, we've talked about this before, but we always want to listen to CEOs and say they're kind of the strategists, they're the ones thinking big picture. But it's also really, really important to listen to the CFOs, who tend to get really down into the dirt. And so I'm going to be listening to both for both the strategy as well as the hard data.
Will Happy Talk work for the likes of Meta or even Alphabet, given how much the shares have gained so far this year?
I think we've taken some pressure off of those stocks in recent weeks as, some prices have come down and we've seen kind of growth in general as a factor fade a little bit since the end of the first quarter. That said, they really do need to deliver, I think. These are well-owned names. They're well-loved names. They're names that are expected to really lead the market, not just through 2024, but through the rest of this cycle. So I think it's possible for them to get people excited, but we recognize that they're well-held, well-owned going into reporting.
Moving outside of big tech, your idea here is a really fascinating one, that the biggest risk is upside risk, that we actually get better than expected earnings data, and that could fuel a rally among a lot of pessimism still out there. Yeah. Why do you think that's the biggest upside risk at a time where it seems like there's still a lot of bullish sentiment right now?
So I think it's about the mechanics of how we get to the bottom line that really matter here. And in this case, I want everyone to have some confidence in U.S. companies doing the right thing, continuing to manage their costs, continuing to manage their labor force, thinking really long and hard about where they're putting their dollars in each businesses so that they can really deliver on earnings. Even in an environment where revenue growth is just okay, and I think we've heard that from some of the companies that have reported so far, it's really the bottom line I want to see companies deliver on. And we saw, actually, since the earnings recession ended, that this focus on cost control and this focus on delivering earnings has been front and center.
This doesn't speak of some sort of screaming hot economy, though.
Yeah, I don't think we want a screaming hot economy for a variety of different reasons. We want a solid economy. We want solid demand. We want rates and to be stable, and we want certainty, or at least lack of uncertainty when it comes to policy. I think that's an environment that corporates are looking to, kind of capitalize on, and that they do well on. And one thing we're not mentioning here is the election year, and of course, the uncertainty around the election outcome and what that might mean for policy is weighing on companies a little bit. So if we have stability in these other areas, in growth, in demand, and policy rates are relatively stable, I think that gives them some confidence to continue to do these cost cutting and really managing their margins.
How are CEOs thinking about the election? I imagine on these earnings calls, they get asked about it, and they have to really walk a very fine line, be very careful.
Yeah, I mean, I think that they're being deliberately evasive because they don't really know what to expect. And we know that there's a huge amount of different policy outcomes for both administrations, depending on who wins in November, because a lot is going to depend on Congress. So they don't want to bank too much one way or another on support or on challenges. They're just trying to kind of manage over the next few quarters.
But given the fact that we do know who these two individuals are, they're basically two incumbents up against each other. Does that help executives plan for the future?
I think we understand big picture some of the main tenets of each of these or the policy programs. That said, it's really hard to say what the details are going to be, what the timing of any changes might be. And I'm going to go back to this Congress point again. There's a limitation to how much an executive can get done, a chief executive in this case, without support from Congress. So I'm going to be watching, frankly, the Senate and House races very closely going into the fall.
Which is the reason why a lot of people are looking for some sort of split in terms of Republican and Democrat on the different sides of the government. I am curious about what you said, which is at least stable rates.
Yeah.
Which raises this question, if the Fed holds rates at this level, is that fine? As long as there isn't any volatility, that's going to be enough to potentially fuel a pretty significant rally in equities?
I think stability and certainty are things that equity markets love. Right? And when it comes to rates, would it be nice if we saw some rate cuts? Sure. But we also know that 80% of U.S. large cap debt is long-term fixed. We don't really have to worry about this in 2024 or even the beginning of 2025. What we do want to kind of, be able to incorporate is, expectations for the next couple quarters. And if we're constantly adjusting and it's, will the Fed be cutting or will they not? I think that holds back some decisions that corporate leaders need to make, which would be supportive for growth. So stability is better than any outcome, I would say.
Well, to Annmarie's point, it's hard to talk about stability at a time where we can't really come up with any clear narrative. When we're talking about the potential for tariffs, and we're talking about geopolitical risk. I mean, how much does that sort of give you some pause in terms of the degree of bullishness and where you're looking to hedge just on the margins?
Well, I think the thing I'm watching in regards to that uncertainty, the geopolitical uncertainty, and perhaps the policy, the government policy uncertainty, is what happens to capital expenditure. And particularly if companies just go through with regular maintenance, necessary CapEx, and hold off on real expansionary CapEx until they get through the U.S. election. But of course, we know it's not just the U.S. election. There are elections all over the world this year. And frankly, U.S. companies are mostly, or many of the large cap ones, are geographically dispersed, right? So they have big businesses in many different regions. So policies in each of those regions will affect their decisions. So I'm kind of waiting to see, how do they talk about capital expenditure? Are they waiting to get more clarity on the political side, or do they see such a long-term secular tailwind to whatever this project is that they're willing to spend despite the uncertainty?
Are international companies better hedged or worse hedged right now, given the fact that they do face different political regimes and, frankly, different economic realities?
Well, it's very, very challenging to manage a global multinational corporation. Regulations here, political change there, change in demand, consumer behavior. So I get all of that. I like the geographic diversity, though, of these multinationals. I think that's going to really lend strength to them through multiple parts of the business cycle and through all of these elections.
You like Japan. Can we finish on Japan?
We can.
Does the FX market matter? Sort of preoccupied with the prospect of breaking through 155, which we're about that far away from doing. Does that matter?
I mean, it matters, but I think there's more on the ground that we like about the Japanese market.
That's what we hear. Can you go through the details?
Yeah, I mean, I think that we're seeing a change in consumption. I think for the first time in a very long time, over 10 years, a real shift in how corporates are being forced to behave, which is much more shareholder friendly. Would I like to see more Japanese individual investors buy into the market? Absolutely. We don't want this just to be a market that's participated in by international investors. But I think both the macro side and some of the structural bits in the market are quite supportive. The currency could be supportive as well, but I don't want to base my thesis on that because, frankly, I don't have a great track record on FX trading.
Yeah, FX is difficult, but what I hear from you is this is not just some sort of short-term tactical trade. This is fundamental, much longer term.
We believe it's fundamental. And so we're buying really high-quality companies that benefit both from things like, the macro demand, global demand, so this is where geographic diversity really helps, as well as companies that are going to kind of come up in the market as they make these big corporate changes.
Kate, this was awesome. Kate Moore of BlackRock. Dollar yen. I think we're just going to focus on it as it gets closer and closer to 155 as we speak. 154.97, the high of the session. Let's give you an update on stories elsewhere this morning. Some actual news. Your Bloomberg brief. Boeing shares trading higher in the pre-market. The company reporting earnings that beat Wall Street estimates. It also burned through $3.93 billion in cash in the first quarter, a less dramatic drain than analysts had expected, as the embattled plane maker continues to slow output to get a handle on its manufacturing issues. A second story, Tesla, shares surging in the pre-market, up by almost 12%. The EV maker is accelerating the launch of less expensive cars in an attempt to revive sagging demand despite multiple price cuts. The news overshadowing a big shortfall in the company's first quarter earnings. Tesla reporting worse than expected revenue and profit. CEO Elon Musk saying he wants to start production of new, cheaper models this year, aiming for an early 2025 rollout. And finally, Secretary of State Antony Blinken in China ahead of meetings with senior Communist Party officials. The trip starting in Shanghai before he heads to Beijing to round out the week. Blinken expected to discuss China's manufacturing overcapacity and trade with Russia supporting its war against Ukraine. We're reporting here at Bloomberg that a meeting with China's President Xi Jinping is a possibility. Now, Annmarie, I feel like these comments on China have been on repeat now for the best part of 2 weeks, and we've all been asking the same question. Show me the policy.
Well, there's two policies to look out for. One is going to be the tariffs, the China EVs that Secretary Janet Yellen went to great lengths to talk about when she was in China, but then also this idea of the U.S. administration very concerned about how Chinese banks, these secondary sanctions potentially we could see on Chinese banks that are helping Russia.
Look out for headlines on that visit for the next 24 hours or so. Up next on this program, Congress passing critical aid for Ukraine.
America sends a message to the entire world. We will not turn our back on you.
America stepped up, and the Senate held firm.
That story up next, live from New York. Good morning. We should have just sat here and stared at the chart together. Dollar yen. Let's share it as a chart together. Dollar yen breaking through 155. There it is. Magic. 154.91. I don't know if I should play this game, Bramo. We're coming to April. Let's go through it. We're threatening to break 152 and everyone's like, oh, do that. They're going to be busy. They're going to get into this market. That happened. 153. Nope. 154. Nope. 155. That happened a moment ago. We're at 154.90. They might, but I think it's curious, and we mentioned it a little bit earlier this morning, they've been much quieter, on the record at least, over the last 2 weeks than they were when dollar yen was much lower than where it is right now.
How much is this the market daring them? The verbal intervention not working time and time again, and basically saying, you want to come out? How much more credibility do you want to lose? Ultimately, this is the reason why Bank of America is saying that we could see 160 before you could start to get some real policy changes. What could they do other than maybe rate cuts?
Let's game this out. We can spend a little bit of time on it. I don't know what kind of level it would take for them to step in, but to Lisa's point, you lost credibility by using verbal intervention when we were south of 152. We were now north of 155 just months ago. You come out and act, and it continues to weaken. You lose even more credibility. You're fighting fundamentals here. They talk about disorderly moves and excess volatility. Very hard to describe what we've seen in dollar yen so far year to date as excess moves and disorderly.
It is completely logical if you have the rate differential that you currently experience between the U.S. and Japan, which gives them two levers. They can either see the U.S. economy weaken and take that advantage to try to take some strength back for the yen, or they could raise rates.
We'll sit here and we'll wait. Not literally, but,
kind of.
We'll be monitoring it. 154.93. Under surveillance this morning, Congress passing critical aid for Ukraine.
After more than 6 months of hard work and many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you.
Even as loud voices here at home insisted on abandoning the responsibilities of leadership, America stepped up and the Senate held firm.
Here's the latest. President Biden is set to sign a long-delayed $95 billion aid package into law, providing funds to Israel, Taiwan and Ukraine. The legislation clearing the way for immediate arms shipments to Kyiv. General Mastin Robson, Academy Securities Advisory Board member, joins us now for more. General, thank you for giving us your time this morning, sir. Let's talk about that number. How far does $95 billion go in today's warfare? What difference does that make?
It makes a huge difference, but it doesn't go far enough to win a war. So it can certainly be a major movement to their ability to stop some of the aggressive activity Russia's been doing and hitting the homeland. But they still have shortages in air defense and in missile defense that they're going to have to tighten up in order to really be effective. The real key is, no matter how effective they are at stymieing Russia's aggressive activity, can they, at the right point, position themselves for a counteroffensive, which is the only way they can really change the dynamics of the war long term?
How quickly can the United States get their ammunition out of these stockpiles to the Ukrainians on the ground?
Yeah, that's a great question. It's my understanding that the transportation skids have been greased and that we're going to be able to accelerate the movement of the ammunition and equipment that's been promised. But your guess is as good as mine. We've got so many, as you know, disruptions in the supply chain right now that we're going to have to move through. And much of this is going to have to go by shipping, which will make it difficult. So your guess is as good as mine as whether or not we'll be able to circumvent those roadblocks that we've been dealing with for the last really 6-8 months.
General, you said it's enough to support Ukraine, but not enough to win. What would Ukraine need to win?
That's a great question. I think really to win, they're going to need more of an offensive strike. They're going to be more, what would include jets. It would include more long-range attack mechanisms. But what they're really short of right now is people. The ammunition and the equipment will be key, but they're running short on people. And if they can't backfill that, if they continue to just grind against Russia and in essence lose their manpower and don't have the ability to backfill that with not just people, but with trained people, then it's going to be tough. Keep in mind that it's always easier to be the defense than the offense. It's a 3-1 ratio is what we historically state. So they will be able to hold out longer in the defense with less people than go on the offense. but they can't win without either a negotiated settlement or going on an offensive that, in essence, facilitates making Russia's advances untenable to cause them to draw back. Obviously, what the best outcome would be a negotiated settlement, but it's just hard to see that right now. That doesn't trade territory for peace.
So how do you see this ending, General, at a time where the appetite politically to give more aid to Ukraine is definitely waning, and there's a question of how long they can just sustain this assault time and time again?
And there is no answer to that. There's no doubt that one aid package is not going to be sufficient. One aid package gives them another maybe 6 months to be able to dig their heels in. A lot depends on how aggressive Russia is in a counteroffensive this summer. If they can really become aggressive, but keep in mind a complex obstacle belt that Russia has put up works as much to the disadvantage of their pivoting to the offense aggressively and with speed as it does to prevent Ukraine to pivot to the offense. So Russia is not going to be able to move quickly. It's going to be a slow grind, which certainly works to the advantage of Ukraine time-wise, but it doesn't give them the ability to win. It will take more aid from Europe. It'll take more aid from the United States, late summer, early fall, to take them to a place that really doesn't give them a chance to win, but maybe brings Russia to the point where Russia is willing to do a negotiated settlement. But you know as well as I do that Russia doesn't show any signs right now of weakening on their willingness to give up the territory that they've gained or to give up on their hope that this piece of terrain is really part of Russia and they by rights should be able to claim it.
If this is what happens, that eventually there is some agreement after Russia has taken some of Ukrainian territory, how at risk is the rest of Eastern Europe, as some people are arguing, to a Russian invasion?
No idea. I would like to say that historically speaking, Russia has never legitimately invaded Europe. They have certainly gone into the states that they're in now when they formed the Soviet Union. But from a Russian standpoint, Europe has invaded Russia twice. They've never invaded Europe. It's hard to predict Putin. I mean, Putin has certainly an appetite for grandeur. And that's dangerous when you have a dictator who has both capacity and capability and an appetite. Will he be satisfied with just a piece of Ukraine? Will the negotiated settlement give what's left of Ukraine a favored status or even a fast track into NATO? Those would obviously be significant movements in regard to if Russia does more, then does this draw NATO into a conflict? But it's almost impossible to predict what's going to happen. We haven't been able to predict the last 2 years of what was going to happen. It's been so fluid.
Yeah.
There's so many different political avenues here in Europe and in the United States and in Russia that impact all that decision making.
General, this was a clinic. Let's do it again soon. General Maston Robson there of Academy Securities. MH, what he said there I think is really important. Either you come up with a heck of a lot more money than we came up with overnight, and $95 billion is a lot of money, or you're going towards a negotiated peace settlement. The latter is hardly discussed. I find it really interesting. You speak to the generals, and this is what they tell you. But when you speak to the politicians, they won't even entertain the latter.
Not on the record and not in public, because that would basically implying that Ukraine cannot win this war. And that would be giving Zelensky the leg down that he doesn't need. He really needs the support right now. And what's the point of sending those weapons if they don't think he's going to win?
Coming up next on this programme, we'll catch up with PIMCO's Tiffany Wilding, reacting to durable goods data, looking ahead to GDP and PCE later on this week. Dollar yen, hello 155. That's next. The key dropping by the studio to break down some economic data. That data out in about 20 seconds time. Let's whip through the price action for you. Starting with the S&P, futures positive 1/3 of 1%. The Nasdaq up a punchy 3/4 of 1%. In the bond market, yields drifting higher through much of this morning. On a 10-year right now up 3 basis points, 463. On twos, just about unchanged, 493.73. And in the FX market, this one not a snooze. Dollar yen breaking through 155. We're talking about levels we haven't seen in more than 30 years. 155, it's sort of round number roulette on dollar yen through the month so far. 152, 3, 4, 5, and we're all waiting for the same thing. Are they going to intervene? We'll see. Let's get some economic data. Mike McKee, what have you got?
Well, we got durable goods out this morning, and the numbers are better than anticipated. 2.6% gain for overall durable goods. That's after 1.3% the month before. In terms of ex-transportation, up just 0.2. There's a big Boeing effect in there because Boeing sold 113 airplanes in March, took orders for, and only 15 in February. So a big change we know coming from the Boeing orders department. Capital goods orders, non-defense, ex-air. This is the part that feeds into GDP, up 0.2. After a downwardly revised 0.4 gain last month, and shipments for March up 0.2 after a 0.6 decline the month before. That's a bit of good news for the economy, but the thing overall that has been bothering some economists is that we have seen capital goods orders running behind shipments for the last year, and that suggests that maybe we are going to see a decline in overall business spending at some point. Last time we got GDP, and we get GDP tomorrow for the first quarter, but for the fourth quarter, it was the second month in a row that equipment spending was down. So that's why durable goods matter, even though they're tremendously volatile. They give us a picture of maybe what's coming.
So this data, Mike, preliminary read on the month of March, so that wraps up Q1. Based on what we understand about the first quarter, have we got a decent read on what we're going to see tomorrow morning?
Well, you got somewhere in a range. The Bloomberg consensus forecast of economists that we've surveyed is 2.5%, which is still stronger than the 1.8 to 2% that the Fed thinks is the sort of neutral growth rate. And the Atlanta Fed GDP, now they'll probably incorporate some numbers from durable goods in there, is 2.9%. So we could see a stronger the lean is to a stronger growth number tomorrow. In any case, it's kind of hard to see how the economy could get a whole lot better at this point, and it's hard to see why the Fed might, well, we'll know Friday when we get the PCE inflation numbers, why they might want to be cutting rates now. They can wait.
Well, this is what Mike Schumacher of Wells Fargo is saying. He thinks the bar has actually gotten higher with respect to cutting rates just simply because of how hot the data has been or just how strong the U.S. economy seems to be. Do you have a sense, based on some of the rhetoric we heard, not this week because it is the quiet period, but in previous weeks, about how much they have kind of shifted the sense of how many weak prints they need before they can have the conviction to cut?
I think the weak prints would be a totally different story from an inflation print data that they're looking at. Weak prints, they would need a couple of months at least of rising unemployment, significantly rising unemployment. We go back to the SOM rule. Do we see it go shooting up? For inflation, they're going to want 2 or 3 months now because we've had 3 months of inflation going the wrong way. So I think right now, the earliest you could possibly see, unless there's some big surprise in the next 2 days, is July. But the September-November time range for the Fed is probably the most realistic if we get the economy, as they put it, developing as expected.
Mike Schumacher was also talking about the point that Powell will want serious consensus across the board before he goes for that first cut. Do you see that possible, given the rhetoric we've heard from some of these officials?
Oh, I think it's possible. I think what you've got now is sort of developing consensus that they're not going to be cutting anytime soon. So if they push it back, that just by nature means fewer this year and probably means fewer for 2025 as well. The economy seems stronger than the level of rates implied by the last dot plot would give you. So we may not see them cut as fast or as much. But Powell generally works by consensus, and he probably can get consensus on this. I don't see anybody really lodging any kind of dissent. Most of the bank presidents are on the same side. A couple of the governors may be looking to disagree, but by tradition, lately, last 10 years, 15 years, they don't dissent.
They hate it. Yeah. Lisa mentioned it's the quiet period. We've got the Fed decision next week. Mike, how big is that? Based on the amount of communication we've had over the last week, could we get anything new next Wednesday from the FOMC?
Well, people want to see something new. Markets want to trade on something. So they're going to be looking at Jay Powell. Nobody's expecting him to do anything on policy, and there's no new economic projections. There's no new dot plot this time. So they're going to be looking at Powell's news conference. And everybody went back and looked at December and said, OK, he pivoted to a dovish stance. I reread the transcript, and I'm not sure I see as much of that.
Well, now
but people give that
the
credit.
Pivot to the pivot.
Yeah, so now there's a thinking that, well, maybe they pivot the other way because markets have priced out too many cuts or something. I'm not sure that he's going to see it that way.
That's a U-turn.
Collective sigh around the table. It's like staring at the sun. Michael, thank you. Mike McKee. It's like that Laurie Calvasina line over 100%. At RBC. It's just like staring at the sun. That light's really bright too. Equity futures on the S&P. Positive by a third of 1%. Don't stare at the sun, children. In the bond market, we look like this. Isn't that what the kids say?
No.
You know,
You can do it with
say
the
to the kids
glasses.
when we had the eclipse the other week. Don't stare at the sun.
You can
I still
with the
love every
glasses.
time I say that. I think of the former president staring at the sun on the balcony of the White House.
Yeah, I saw people using two things of sunglasses. I wanted to go over them and say, no, please, come on. No.
Still got those spots in my eyes now. Anyway, up 5 basis points on a 10-year, 465. On a 2-year, up a single basis point, 495. All the attention on dollar yen. Briefly breaking 155 and back down to about 154.98. Bramo, dollar yen. We've gone through so many round numbers this month. Why is this one any more important than the last one?
Just each time you're sort of boiling the frog, right? You're sort of amping up the pressure and raising the question of, okay, if they're not going to intervene here, they're not even going to jawbone it. Well, then what's next? What level do they start to worry about? Since we haven't heard from them, I think that's really the question. At what point is that taken off the table, and how far can traders push this?
Do you think there are certain times of the day, in certain periods, maybe in certain regions where there's less liquidity, that they'd want to step out and step into this market, that maybe now's not the time? Maybe a little bit later tonight.
Are you suggesting that Asian hours of trading, when it tends to be
Just
thinner
saying, when liquidity is low
time?
and you want more bang for your buck. Mike McKee dropped by the studio. Can we just 30 seconds? Mike, go through those numbers. Go through those numbers.
The Bank for International Settlements tracks the amount of currency traded. Do a survey every 3 years. 2022, last time they did it. $7.5 trillion traded every day in the Forex markets. And in 2022, the last time Japan intervened, they spent $60 billion US. So moving the markets is very difficult. It's a psychological thing, and usually you're looking for a turning point. You're looking for a bad economic number or something like that that moves the currency, and you pile on and you push a market that's already going in that direction. But right now it doesn't look like the market's going in that direction.
At all. No, 155, 154.99. On the data this morning, the data tomorrow, and going into the Fed next week, I'm pleased to say that with us is Tiffany Wilding of PIMCO. Tiffany, wonderful to catch up with you again. Just had a bit of economic data this morning, going into GDP tomorrow. What are you expecting from the first quarter, and how do you think everything we've seen in the first quarter of this year will shape the conversation next week?
Yeah, so we're looking for a pretty strong report. I think the Bloomberg consensus, as you mentioned, is 2.5, but our lean as well is on the higher side of that. And I think the more important thing that we'll be focused on, is just the core measure of GDP, final domestic demand growth, which economists call it. That's going to be incredibly strong. That strips out the volatile trade and inventories categories, and that looks like that's going to be above 3. And the thing that we've been really highlighting and focusing in is that will be the third quarter in a row that we've gotten core GDP growth of above 3, and that's something that we haven't seen since 2014, absent the pandemic-related rebound. So all of this is to say is that GDP in the United States is incredibly strong, and that strength has continued after 2023. We've seen strong momentum going into 2024. All of that suggests that inflationary pressures in the economy, we're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
Do you think that will shape the language in the statement next Wednesday when we open that up at 2 p.m. Eastern time? Is that going to look any different?
Yeah, I think you could see some changes to the statement, but I think what markets will be more focused on is what Powell says in the press conference. And his, in the past at least, Powell has made reference to the SEP projections, prior SEP projections at a non-SEP meeting, and given us some hints on how he thinks they could change. And we think that's potentially what he could do now, set the stage for more revisions to the SEP that we're going to get in June, say that the inflation forecasts are likely going to have to be revised up, and then as a result of that, sort of hint at the fact that you could take out maybe 1 or even 2 cuts in the forecast for 2024.
Tiffany, I hate to do this. I feel kind of a little bit dirty doing this. But is this a pivot to the pivot that we got in December?
Well, it does seem like, in some sense, the pivot party from December is over. And I think that's as a result of the inflation prints that we've seen. And again, just the economy is just incredibly strong. We have argued, that the so-called last mile on the inflation in the inflation race is going to be the toughest. And that's just because we have a strong economy, labor markets are tight, and that just is likely to result in inflation hanging above their target. And really, the question is are they okay with that? And it seems like, there is some threshold. Maybe we think it's 3% where they won't be okay with that. But, above 3, it's okay. But again, it's a bit, monetary policy is a bit of an art and a science here. So, I think the art is that, they don't really need to be cutting. They shouldn't be in a rush. And so really it's up to them to choose when they start to do it.
You said the pivot party is over. And when people were talking about the pivot party, it was including a real rally in risk assets. So I wonder, okay, pivot party is over. The earnings party just getting started. Is this basically an economy that can handle where we're at right now? And that's basically what we're hearing from a lot of people around this table.
Yeah, I mean, it's certainly the equity market, we look at equity risk premiums, and even though you've seen some weakness in the equity market, the additional yield over treasuries, earnings yield that you get over treasuries is still looking okay. We're still looking rather narrow in the equity market. So from a valuation perspective, equities, still look somewhat rich here. But nevertheless, I would just say if we look at the GDP data, the data that I focus on more, we're seeing a reacceleration in cyclical sectors of the economy. That is residential investment, even in CapEx and things like that. Corporate profits, NIPA corporate profits have reaccelerated as well. So, and this is at these high level of interest rates. So it does seem like the peak effects of the monetary policy drags, they are increasingly behind us. And that suggests that, maybe the economy can withstand rates at these higher levels.
Which raises this question, how much do financial conditions, frankly, how rich stocks are, how well bid credit markets are, how much does that influence how long inflation can be persistently above the Fed's target?
Yeah, I mean, I think overall, the Federal Reserve monetary policy works through not only the policy rate, but a broader context of financial conditions. And the point that we've been making lately is that you need financial conditions to tighten here in order to cool the economy down. And the question is, how does the Fed engineer that? Now, partly they can engineer that through just staying on hold. The bond market is still pricing in cuts. So the longer they push that out, stay on hold, that should sort of mechanically tighten financial conditions. And I think that's what the Fed will try to do, and just see if that's enough. And maybe rates on hold longer will get them that financial conditions tightening that they need in order to cool things down a bit here. But of course, if not, then they'll have to find other ways to try to tighten a little bit more.
I know we're all focused on inflation this week, but I wanted to ask you about the jobs market, because in your note, you talk about elevated immigration boosting both supply and demand. What happens if we still don't have those same levels of immigration, whether or not it's executive order that Henrietta Trace says potentially coming out of the Biden administration, or a whole new paradigm next year if we get an entire different administration?
Yeah, so that will result in growth slowing for sure. Because immigration boosts both supply and demand, the effects on inflation are more nuanced, we would argue, and they're less clear. So, what we could see is if you have immigration that is falling, we've had a lot of asylum seekers cross our borders over the last couple of years. We estimate that that's contributed around 50 basis points to 100 basis points to GDP growth. So if you don't get that, we will absolutely see growth slowing. But in terms of the inflationary effects, that's certainly less clear. Now there are folks that are in the economy now. They have workers' permits. They're waiting for their asylum hearings. I guess if there's policies to try to, make them wait in Mexico or other places like that, that growth drag will be even more. But we'll just have to see how that plays out.
Tiffany, as we were talking, and we're talking about U.S. strength, how pronounced it is, how much longer it could last, I was just thinking of your cyclical outlook that you helped lead, and reading through that note, the amount of divergence that we can expect. What about everybody else? What is the growth backdrop going to look like, the U.S. versus the rest of the world?
Yeah, well, ultimately, we still think that, there is some durability in this U.S. exceptionalism story, that started in 2023. And really the factors that we believe contributed to that was just the fact that the U.S. government fiscal stimulus during the pandemic was much larger than it was in other developed markets. We've also seen, what I call less mean reversion in our federal government fiscal deficit since then. They've been kind of structurally hanging around 6 to 7%. Everybody else has managed to get, more fiscal retrenchment. The other thing for the United States is that we've seen less pass-through of monetary policy, via the interest rates that people actually pay. We have a large stock of mortgages that are, low duration, low interest paying, long duration, low interest paying. That's just not, the consumer is not feeling really the effects of higher mortgage rates in the United States. They are elsewhere. So we think these things can continue, at least through our cyclical horizon. I think structurally the U.S. economy is also just delivering better productivity growth than some of our peers. And I think that can certainly continue, versus Europe, for example, where they've had, a pretty big energy shock that's made them somewhat less competitive. Obviously, weakness in China has also had a bigger impact on Europe. But all of these things in our minds can contribute to this U.S. exceptionalism story. And eventually, that's also going to create divergence in monetary policy, we think.
Tiffany, enjoyed this and enjoyed the note as well. Tiffany Wilding there of PIMCO. Just getting an important headline crossing the Bloomberg. Very light on detail, but want to bring it to you. MH, what do you see?
Israel striking 40 Hezbollah sites in South Lebanon. Remember, of course, we've been waiting if potentially there's going to be more skirmishes or, strikes between Iran and Israel. This looks like Israel is striking Hezbollah, obviously a proxy of Iran. But then also, Jonathan, I'm seeing as well an alert from the AFP saying Lebanese Hezbollah has launched, quote, dozens of rockets at Israel after civilian deaths. So it seems like this is going both ways.
A developing story. When we get more detail, we'll bring it to you. That's the latest so far. Allow me to bring you some detail on stories elsewhere. Let's get to your Bloomberg brief. Your first story. Talks to resolve a standoff between pro-Palestinian demonstrators and Columbia University officials are extended after a deadline expired at midnight. The Columbia Spectator reporting that the two-day extension came after significant progress in discussions. Student representatives agreeing to 4 commitments, including cutting down on tents in their protest encampment. House Speaker Mike Johnson set to meet with Jewish students at the university later on today. The clock is running for TikTok. President Biden plans to sign an extensive foreign aid bill today, which includes a provision demanding the platform's parent company divest or face a ban. ByteDance now facing a 270-day countdown. The Beijing-based company has vowed to do all it can to stop the measure. The company says the legislation infringes on the free speech rights of its 170 million US users. And finally, a new Department of Transportation rule says airlines must provide automatic refunds to customers for cancelled flights. The DOT's new regulations saying passengers will be owed money back for any so-called significant changes to their travel plans, including delays of over 3 hours on domestic flights, an increase in the number of connections, and a whole lot more. Secretary Pete Buttigieg saying the following: passengers deserve to get their money back when an airline owes them without headaches or haggling. I think we can all agree on that. Up next on the program, AI in the spotlight.
Microsoft has a very big report this week. This has always been known as the cloud bellwether. It is now the AI bellwether. If we continue to see that ramping up, I think the market will be very excited.
That conversation up next, live from New York. This is Bloomberg. 40 minutes away from the opening bell. 2 days of gains on the S&P. Solid day of gains yesterday. The biggest one-day gain we've seen going back to February. Equity futures up 0.1%. Yields drifting higher once more, up 5 basis points, 464.58. The euro weaker, dollar stronger, including against the yen. Briefly, 155. Done that a few times already in the last 20 minutes or so. 154.98 this morning. Under surveillance, AI in the spotlight.
Microsoft has a very big report this week. This has always been known as the cloud bellwether. It is now the AI bellwether. This is where the real growth is happening if you look at certain pockets. Outside of that, we're seeing a lot of deceleration if you look very closely. So we want to see Microsoft continue to do what it did before. We're talking on about $75 billion segment. If we continue to see that ramping up, I think the market will be very excited.
Here's the latest. Max 7 earnings in full swing with Meta reporting after the closing bout today. Microsoft, Alphabet, they're due to report tomorrow. Microsoft in focus for many investors, with the company leading the way in the deployment of artificial intelligence. Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, good to see you. Let's talk about the numbers we get later before we talk about Microsoft. That's the big one I know for you. Meta, what are you expecting?
Well, Meta, I think what they have done is, one, the year of efficiency was a winning move. And, you're seeing that EPS estimates go up by almost 40% for 2024 as a result of that. And they've actually made that pivot to AI, which everyone wanted them to do, in terms of shifting from metaverse to AI. And that also looks to be a very smart move, because now they have a large language model, their own model, where they can build an ecosystem. I do think they should move away from hardware. They'll never be successful in hardware, but they still are spending on reality.
Never's a strong word.
Well, simply because they have spent, almost $50 billion trying to develop, VR, AR glasses. And look, I mean, it is a niche category, but when you have got Apple stepping into it, and clearly they can't make a dent in terms of, driving revenue out of that, that tells you something. And it's just so hard for Meta to create an ecosystem as a hardware maker. So I have my reservations in terms of how that strategy may play out. But look, as long as they keep growing 20% plus, nobody minds them losing $4 billion a quarter on Reality Labs.
I love this. I love the. Are they going to rename from Meta to AI at this point to try to get a better branding at this point? I'm curious about how low the bar really is. And we got that sense from Tesla. Are they setting the tone for earnings, even for the likes of Meta, where shares are up 40% year to date?
Yeah, so they have shown that they can grow over 20%. The one caveat I would flag here is they have exposure to Chinese advertisers. So they have no China revenue exposure, but Chinese advertisers like Temu, Shine, and to an extent TikTok as well, they advertise on Meta's platforms. And that revenue is close to 10% of their overall revenue. It was 5% of growth last quarter. So if things go south in terms of advertisers pulling back, and look, this is an auction mechanism, so it's not as if that revenue will go to zero. There are still advertisers who would bid for those ad slots, but that ad pricing would take a dent if, the Chinese advertisers pull back.
I'm still shocked that you don't think Meta has a chance in these wearables, because the Ray-Ban glasses are a much better price point, and they're actually kind of cool.
But you know how much they're subsidizing? How much is Meta subsidizing the cost of that Ray-Ban glasses? The reason why they're so cheap is because Meta is subsidizing the hardware.
Wow.
That's the dent in the $4 billion every single quarter. Is that how much money they're spending?
They have no markers on what they spend those $4 billion on. And when they were growing, low single digit, everyone was asking, okay, what's going on? Now nobody cares because they're growing over 20%.
Quick final word. Microsoft going into tomorrow. Is that the big one for you, and why?
It is huge. It's, I think, the company that's able to monetize AI, both on the cloud side and on the product side. And look, I think what they've done is developed an ecosystem where they can actually deploy AI and, have other people rally around it. So think of, the operating system, the iOS and the Android. Microsoft is trying to develop that in AI. It's still early days, but if they're able to do that, they'll be hugely successful.
I imagine we'll be catching up with you tomorrow morning and looking forward to it. Mandeep Singh there of Bloomberg Intelligence. As big tech earnings get underway, yesterday we heard from Tesla. We're going to hear from Meta a little bit later. Tomorrow we'll hear from Alphabet and Microsoft. Then on to next week, Amazon, Apple. You get the picture. You're all familiar with the calendar. Here's tomorrow morning, the lineup for you. Chris Harvey of Wells Fargo, Greg Peters of PGIM. We'll speak to Bob Doll of Crossmark, and we'll catch up with a Stifel CFO, Ronald Krzyzewski. Looking forward to all of that. We'll break down US GDP, have a chit-chat about jobless claims, and push ahead to a Federal Reserve decision about a week away. Going into the cash open, 34 minutes away. Equity futures just about holding on to positive territory. We're positive by 0.1%. Coming off the back of 2 days of gains on the S&P 500 and the biggest one-day pop going back about 2 months. More supply coming a little bit later. Bramo's working the late shift this afternoon.
Oh, yeah.
Watching that 5-year auction.
It's going to be thrilling.
Yields up 5 basis points. Your 10-year, 4.65. Live from New York City. This was Bloomberg Surveillance.